No, I mean, not this question.
Well, you're in all new ways. I'm trading at 10.47. You gotta work so hard to make those returns in multifamily.
Yeah, breathe.
That's the take for 5. Long-term contracts. Spread it off. I just don't understand. Well, especially with the rest of the world. Well, they're going to continue to be, they're going to be under a lot of pressure. So they're going to be every year it runs. States and global warming. What they gotta remember is there's a lot of unique things that are invested in this state teachers and government systems that depend on those values.
Good morning, everyone. Good morning. No, it's exactly the same. We're rolling well. Good morning, everyone. Good morning. Sorry, we're a few minutes late.
Good afternoon.
Well, it's better to have him on the phone than, I guess, in person. Good morning, Senator. How are you?
Morning, everything's fine, hunky-dory.
Why don't we start with the roll call?
Governor Michelle Lujan Fisher,
Here.
Commissioner Stephanie Garcia Richard, Treasurer Eichenberg,
Present.
Secretary Olivia Padilla Jackson, here. Mr. Peter Frank.
Yes, I'm here on the phone.
Thank you. Linda Eitzen, here. Tim Jennings, we know you're on the phone, Tim, thank you. Harold Lavender.
Here.
Lee Rawson.
Present.
Michael Messina.
Here.
And Nicholas Hayes.
Here.
Did you have it, John?
Thank you. And why don't we approve the agenda, which is the next item on the agenda?
Motion to approve the agenda.
Second.
Thank you, Linda. Thank you, Harold. Any comments or questions, statements about the agenda? Mr. Treasurer?
Thank you, Madam Chair. I was really waiting for the consent agenda. I was hoping I could take off the assembly, off the consent agenda.
Okay.
More because I want to vote no on that particular investment opportunity, and I just didn't vote no on that consent agenda.
Understood. Okay. Why don't we then, is that a motion to remove B?
Yes, ma'am. Thank
All
you.
right.
Second.
Give a second. Okay. All those in favor of removing B from the consent agenda, say aye. Aye. Any opposed?
Aye.
Got another aye. Got a couple, I bet. Seeing none, that motion is approved. So do I now have a motion for revised agenda?
Motion for revised agenda, but prior to that, I would like just a reminder of the consent agenda. And this is the criteria that the CIC has already done for every item on the consent agenda. Same fund manager, same portfolio management team, same strategy, same investment process, still meets the SIC asset allocation strategy and pacing schedule. The performance of prior funds met expectations and are in the top quintiles. Fees and terms the same or better than the prior fund. Compared with other choices, it is still the best in class, and investing a similar amount as in the prior fund. So when the CIC looks at an item on the consent agenda, we have reviewed those items before they come to the consent agenda. Also, there was a discussion at the CIC, Commissioner Stephanie Richard, Garcia Richard recommended that we have the fund manager available for at least the first few meetings where we were reviewing a consent agenda to see if the fund manager on telephone is advantageous or not to these additional criteria. So those items have already been reviewed before they come before us at the consent agenda. And I also then move to approve the amended agenda.
I'll second that.
Thank you, Member Eitzen. Thank you, Member Lavender. Thank you also for that description, for particularly, it's always good for the chair to have a review, and I think effective for people who are watching the SIC and joining us via webcast and new members. So I appreciate that very much. Although, all those in favor, I'll call the question on the revised agenda, say aye.
Aye.
Any opposed? Any abstained? Motion carries. Thank you. We are now on the consent agenda, which has only one item on it, which is the approval of the SIC minutes from January 28th, 2020. Do we have a motion to approve the minutes from the January 28th meeting?
Second.
All right. Senator Rawson moves, and then was it Member Tejas? Or Lavender again? Thank you, Harold, for being so quick to get that done. Do we have any discussion on the motion to approve the minutes of the January 28th meeting? Hearing none, all those in favor of approving the minutes of January 28th, say aye.
Aye.
Any opposed? Any abstained? The motion carries. I actually have a question. Now that we've got it, where do we put the item B that we're voting on? After where we do all the business investment matters at the end?
I would think if we follow the consent calendar, we would follow right after it.
Fine with
In other
me.
words, since we didn't approve it, the consent calendar should be the next item of business, I would think.
I believe it's the chair's choice of where you would like to place the
I know you're
item.
shopping at the bin. I might just make you wait. So there's a bunch of other voting stuff.
She needs a raise, Kevin.
Wasn't that good? Right way. Which made me seem so smart. I love that. I'm happy to do it right now if you're prepared. Let's do that. We want to have a presentation then, please. We'll have, do we have Bart Stuckey, is he here? Yep, Bart, I didn't see you back there. That's what happens.
Good morning.
Have phone books. Good morning.
So today joining me is Brian Goldberg from Axion, our consultant.
Welcome, Brian.
And we're bringing forward today HPS SLF 5. The SIC is also invested in funds 3 and 4. And we're bringing forward a commitment for 125 million recommendation for HPS SLF 5 today. This will fit into the lending strategies category, the non-core fixed income portfolio. And last month, we reviewed the structure study for all fixed income, including the non-core fixed income portfolio. And we discussed the restructuring that's been going on in the portfolio, where a few months ago, 3-4 months ago, we sold $240 million of bank loans in the lending strategies subcategory, and HPS, the HPS fund will be filling that gap. So what we've done is we had a discussion at the CIC in terms of where we are in the credit cycle. And so what we've done is sold the underlying risk for both of these types of funds is corporate credit. So we've sold $240 million 3 or 4 months ago to be reinvested over the next 3 years by HPS. And so if there is any disruption in the cycle, HPS will be investing into a more opportunistic environment with higher, better opportunities. So HPS operates in the direct lending portion of the private credit market. This is the largest portion of private credit. Depending on which way you measure it, it's either 35 to 50% of all of the private credit, which is the portion of the market that the non-core fixed income portfolio is investing throughout. And this is a market that's increased significantly over the recent past. But HPS has been able to carve out interesting niches within the direct lending market where they're still able to get great returns. And these niches are, they're one of the few players who can invest at large scale. They focus on complex deals that may or may not have esoteric collateral. They also participate in non-private equity sponsored companies, and they look at a global opportunity set. So that's an introduction to the HPS strategy, and I'll pass it over to Brian for more details on Axios due diligence.
Yeah, thank you. So HPS, as many of you know, is one of the largest private credit firms in the world. They manage approximately $58 billion. It was founded in 2007. They've been in the market for quite a while. The team is led by Mike Patterson, who is the same portfolio manager for funds 3 and 4, as will be for 5. And the investment committee is similar as well. So the senior leadership is stable and is a carryover from previous funds. 26 dedicated investment professionals to the strategy, industry specialization, as well as underwriting specialization and workout specialization. So to Bart's point, in the event that there is a credit cycle, we expect HPS to be in a good position to be able to work out any problem loans that are in the portfolio. The strategy is the same as Fund 4. They are focused on larger middle market lending to primarily non-sponsor companies, so non-private equity owned companies. It's senior lending. They tend to focus on more complicated situations. Like Bart said, some of the loans are asset-backed as opposed to cash flow-backed, so we like that there's collateral behind a lot of these loans. Portfolio historically has been focused in the U.S., does have the capability to be global in nature, but we expect U.S. to make up most of the portfolio. It's highly diversified. There'll probably be between 70 and 100 positions in the fund, so no outsized risk we expect to make its way into the portfolio. They are raising about $5.5 billion for this strategy, which is larger than previous fundraisers, and there is a levered and non-levered version of this fund. And so with leverage, the total raise is going to be in the $8 billion-ish range. That's capital that they'll have to deploy over the investment period. So while it is a larger raise than we've seen out of HPS, based on the pace that they've been investing and based on the benefits of being a large lender and the sort of the synergies that come from an existing portfolio, we expect them to be able to put the capital to work over the investment period without having to stretch for returns. I'll leave it there. I think I can take any questions that anybody might have.
All right, thank you, Mr. Stuckey, Mr. Goldberg. I'm assuming we do have questions.
Thank you.
Mr. Treasurer, so I put you on the spot, but I was assuming you might.
Well, it's not, as, I guess, questions. I was just looking at your view here, page 3 of your report, or page 22. And just a couple of things that you talk about that caught my attention, which is the carried interest. You have 15% over, the 7% hurdle. Are we on the same page here, halfway through?
Yes.
But when you get to page 44, it talks about 5%. And so that was the first thing that kind of raised the flag with me. On the return profile, and you can just kind of check them off and kind of, because these are the things that raise the flags with me. You talk about deal by deal, yet you're reporting based on pool returns. And so that was kind of a concern. And then I guess the biggest one was when you talked about under your financial analysis, you also talk about them not wanting to provide you financial statements as a management company. Now you go on to try to explain that, but then there's not. I didn't see your fees for them being included. And the thing that really caught my attention was an article that was in Barron's back on the 20th of January, where it talks about a little bit bigger haircut than the 3% that you're offering. That should be the first thing because we're not getting that kind of money. And then the covenants on page 44, how the covenants has decreased, it's declined over the last 3 years. And that to me is, it's not given the loss adjustments the proper spread, in my opinion. So now tell me how dumb I am and tell me that I shouldn't be concerned about those red flags. And try to convince me to vote with
I can answer a couple of those and then I'll pass it along to you.
But those are just some of them. I just don't think the 10% gross is good. I mean, just lots of little things.
In terms of the hurdle rate, it is 7%. We're going into the levered option for this fund. That has a 7% hurdle. The 5% hurdle relates to the unlevered option. In terms of covenants, that's an overall industry trend that's going on. That less and less covenants as the cycle has advanced. And one thing we like in relation to covenants with the HPS strategy relative to the bank loans, the portion of the portfolio that we sold recently, that's a portion of the market that's extremely competitive, and companies have been competing not only on tightening spreads but also very low covenants. 85% of the bank loan market is what we call covenant light, where 0% of loans that HPS makes would be considered covenant light. In fact, many of their loans include pretty significant covenants in terms of amortizing the loan throughout the term of the loan. there'll be covenants for that, and another significant covenant we have is cash sweeps often, where if the cash flow exceeds a certain level, that would be swept into to pay down things.
Yeah, I guess the answer is that there are other things in addition to just the covenants that are important to consider, including the quality of the underwriting, which we've seen investment memos we think are highly in depth. Some of the additional features of the loan, the value of the collateral that backs the loan. So it's not simply just the number of covenants. Try to write down all of the questions. Some of the others, the financial statements of the general partner. It's, I don't want to say extremely uncommon, but it's fairly uncommon to receive the financials of the general partner. It's something that they generally hold tight to the vest, because it is sensitive in the sense that it contains, fee information and other expenses and competition. So them not providing that is not a red flag to us. It's more the norm than they're not. And that's the GP financials. That's not access financials. Just to
While you're flipping pages there, on page 19, how much energy? What's our exposure to energy?
So energy exposure was higher in Fund 3.
What's it going to be in Fund 5?
It's expected to be significantly less.
Significantly less?
Yes. The results from Fund 3 lagged the manager's expected returns, in part due to exposure to the energy space, which has been a difficult area over the last few years. Returns overall are still reasonably good, but they're just below target. Fund 4, which the manager purposefully reduced the amount of energy in the portfolio, is tracking right at target returns. It's tracking at 13% IRR currently, although it's still fairly early in the process. So there was a conscious decision made to reduce the amount of energy and the amount of retail exposure in the portfolio going forward.
And they've specifically stated that in Fund 5, they're going to look to reduce cyclical elements such as retail and energy.
Okay, we've got a couple more questions. We're going to bring in a couple more chairs. So thank you, Stephanie. I appreciate that. Senator Ross, I saw that you had a question or comment.
Before we get to my question to HPS, just in terms of procedure, I would suggest, and maybe it's a non-issue with this particular item, but if we put something on the consent calendar because it's a reinvestment of a prior fund, I would suggest that maybe we look at the voting record and see if there's any opposition at the time the original came up. I don't know if there was or wasn't on this, but that might give an indication as to whether there might be the right questions that might arise. But I would think that based on what we passed for last meeting, that any member can take an item off the consent calendar, which therefore voting on that issue, which we did, I don't think is the appropriate process. It's to see if an item needs to be taken off the consent calendar, it's brought up, it's taken off, and placed where we want to put on the calendar. But I don't think we have to vote on that.
Okay, thank you, Senator. I appreciate that. As long as we're doing a voting record for the agenda in general, if someone has wants to move something, it seems to me like that doesn't hurt us at all. But I appreciate that. Anything that makes these smoother and more effective, and folks are clear about what opportunities they have to get to the business in hand, I'm open to getting it accomplished in just that way.
Okay, with regard to HPS, I have 3 quick questions, or 3 issues, and Treasurer's addressed some of it. But on the financial statement, on refusal to give the financial statement, in response to his question, is I understood, Mr. Goldberg, that you said that it's uncommon for the general partner to provide financial statement. The refusal to provide the financial statement is not from the general partner. I don't think that was her question. The question was, I think that was being sought out, was the financial statement of the managing company. Now, maybe the managing company is the same as the general partner, but I don't know that to be the case, because a lot of times the general partner might be might be a different person. You answered general partner. The question in our document had to do with managing the company, so maybe you can clarify that answer.
Sure, I was using the terms interchangeably. So, no, the general partner or management company, HPS, doesn't provide that business's financial statements, or has not provided that business's financial statements.
So in this case, the general partner and the managing company are the same,
Yes.
is what you're saying. Okay, next question is on, at least in our document, page 22, talked about the placement agent. And that answer was, this is not specified. The council has been concerned in the past about the use of placement agents. I'd like to know if there's placement agents used or not. I think that makes a big difference. So,
I don't believe there are.
What's that? There was not any use?
Well, definitely not with us, but I don't believe there's any placement agents used in. No, there are not.
Okay. Then in terms of the criteria, one of the things noted was you avoid a high customer concentration. And I guess I'm playing with those words in terms of, it seems to me that maybe what you're saying is you don't want few customers. Is that right? You want broad customer base? Okay. Because I probably would have worded that different. I just want to make sure I understood where you're going. Okay, thank you.
Thank you, Senator. Member Lavender.
Madam Chair, I just would like to suggest that when we get these materials, if you have these kinds of questions, we address these, almost every one of these at the investment committee meeting. And I would like to encourage members to attend that meeting if they have these kinds of questions. Whole purpose of the consent agenda is to cut down the length and the kinds of things that are covered at this meeting. And I think that each of the questions that's been asked so far today could have been answered and was answered at the investment committee. So that's just like a suggestion. That's the reason we have a consent agenda, so it can be done that way. Clearly, any member that wants to bring an item off the consent agenda can do request to do so. But it seems to me that that's a potential waste of this council's time if that could have been covered at the meeting. Just an opinion.
Understood. I actually have a different opinion, which is, I appreciate very much, I don't know that anyone cares what my opinion is about this matter, but I think we should be re-inviting members of the State Investment Council to come to all the subcommittee meetings and to continue to engage and familiarize themselves with any number of the issues for the SIC. So thank you, Member Lavender, and thank you, Member Eitzen, for recommitting that information is available, that those meetings are occurring, that you can participate. Here's the criteria. I also think it doesn't hurt, as this is a fairly new, with a brand new member council and brand new leadership, that we continue to have these kinds of dialogues and get a sense about what issues concern members. And when we get to a place, if we do, where we can't get through a single consent agenda, or there are issues that take too long, then I think absolutely we might need, and so I'll lean on you, Member Lavender, another reminder about how things get placed on the consent agenda and how much work we want to get through on the council, but also we want to be as engaged and transparent. So I could argue it either way, and I appreciate everyone's participation this morning. Do we have any other questions, comments, concerns, or statements, either about the consent agenda or about this particular matter? All right. Yep.
You know, Governor, it was awful quiet. I always care what you think. I must have been the only one that did, but it must have been just me.
How is he still on the council?
Please.
Kidding, for everyone watching. Kidding. I'm an old friend of Senator Tim Jennings. All right. Hearing no further discussion, all those in favor of the HBS Specialty Loan Fund as presented by both Mr. Stuckey and Mr. Goldberg, I would need a motion to approve that matter. I've got a motion to approve by Member Lavender, a second by Member Eitzen. Any discussion? Further discussion? All those in favor say aye. Aye. Any opposed?
Aye.
Any opposed?
Aye.
All right, we have 2 opposed, make sure I get it right. The state treasurer and member Rawson, Senator Rawson. All right, motion carries. Thank you. All right, we are now on item 3, so we'll have our reports and briefings. We'll go to the Director Steve Mullins.
Thank you, Governor. Morning, everyone.
Morning.
We've been emphasizing the distributions that funds make recently, and this is a topic that I think is of great interest, not just to us on the council and the staff, but to the public. Over the past 12 months, the funds have distributed $995.7 million. If you look at the SIO report under investment matters, where we show distributions, you'll see that from FY19 to 20 and from 20 to 21, distributions have increased from 968 million to 1.07 billion. And those numbers are there to not only help us to understand the good work that the council is doing, the funds are doing, but to also help the public understand that. West Texas Intermediate Oil, as of the close yesterday, was at $51.23. The net asset value of the funds as of last evening was $27.832 billion. Now taking a look at the SIO report page in your materials, in addition to the distributions that I just mentioned, I will skip down to council matters, where you see the March meetings that are listed and the dates and times. There will also be a governance committee scheduled, and that date is being determined today, and we will have that for you in the weekly that Charlie puts out on Friday. The governance committee, as all of you know, has requested that any of you who are interested in serving on committees, let Carrie know so she can pass that along to the committee, and then the committee will make those recommendations to you at the next meeting. And the other topic that was requested is suggestions of advisory members for committees, and some of you have come forth with those. If any of the rest of you have any, please let us know, and we'll see if the committee has those names. Those will be brought to the council, of course, next month. Moving to operations, the second item there, I'm going to ask Brent to comment on the state personnel office changes in HR services effective the 1st of April.
Sure. I went back and looked. The SIC has had a memo of understanding with the state personnel office since, I think, fiscal year 2013, whereby they provide certain HR and personnel services for us since we don't have a person on staff to do that. We were notified probably a month or so ago that they will be stopping doing those services in the future as of the beginning of April. So we're in the process of hiring someone probably over the next 30 to 60 days to actually bring on staff to be able to do whatever we need as far as personnel services.
Madam Chair?
Yes, Madam Vice Chair.
An HR director?
Not an HR director, I would say an HR staff member to at least handle some of the postings, hiring.
So do you need an additional FTE or?
We're gonna, for the current time period, we'll absorb it with the staff that we have. We will probably consider in the future requesting an additional person. But this is, to your question, this is something that was out of our control. SPO has provided those services to us. I think they have reorganized or maybe they're in the
No,
process.
the issue is, if I might interrupt and to your question, Madam Vice Chair, there was, the last administration did state personnel consolidation, which has caused severe interruptions and inability to hire qualified folks at the right departments for the right positions. So this is a return to a previous system, which has each agency identify the kind of improvement tools, the kind of strategies to identify qualified individuals for the special services that each department provides. I don't know how often you're recruiting for individuals at the SIC, but I would imagine actually that it would be a full-time job for the size of the staff. And if you need additional services by state personnel to support those efforts, they are still absolutely available to you. But what you're seeing is a return to getting HR personnel return back to state agencies. So if you didn't have one, you didn't get someone back. But otherwise, those folks are returned back to their originating departments and agencies. That's what we heard.
Thank you,
Sure.
Governor, for that clarification. And we'll reach back to SPO. I think we've had some miscommunications.
Sounds
You're
like
right, probably saying we don't need someone full-time. If we had, another department that we could share a person with, we might consider that, but we really haven't come across a situation where that's going to work out. But that's going to be something that we're looking into in the future. And if SPO can continue to provide those services, we'll probably have them do that.
I'm very confident that's not going to be a problem.
That's good news, Governor. Thank you.
You're welcome.
That's all I have on that.
Mr. Treasurer.
Thank you, Madam Chair. What was the fee that SPO was charging?
Currently, they're charging, I believe it's $19,200. The fee has varied from about $19,200 to about $25,000 where it started. So they've come down over the years a little bit for that fee. And they typically bill that at a quarterly, and we pay accordingly.
And who do you have currently in the office that does your payroll? Do you do that, Brent, or do you have somebody else that kind of watches that for SPO?
Actually, SPO has been the person, like if we have some problems with payroll entry, they'll notify us. We have people in the office that approves payroll, but if there's any follow-up or whatever, they typically would send out to me, and I'll follow up and make sure that, certain items are completed. But they had some oversight responsibilities, which we were led to believe that they were trying to get out from under, but if that's not the case, we'll certainly continue to try to contract with them.
Thank you, Mr. Treasurer. And Secretary Padilla Jackson will also follow up and make sure that you're doing that correctly, we are responding correctly as state government. But that's what's occurring, is that we're putting back those individuals into the departments from which they were transferred out of.
And we completely understand that. Thank you.
Certainly. Proceed.
Thank you, Governor. Thanks, Brent. Under legislative recap, which I know all of you will find interesting. Before Charlie briefs you on what I think was a very successful session with respect to the permanent funds, I just want to convey a few thanks, if I may. Thanks to you, Governor, and to your Chief of Staff, John Bingaman, who's sitting back by the window, as well as Olivia, for the advocacy that you all provided during the session, particularly for the Early Childhood Trust Fund bill and also for the New Mexico private equity bill. We were very pleased to see that both of those cleared the legislation. Also, thanks staff-wise to Charlie for coordinating our fiscal impact reports. There were 14 of them this session, and to Bruce Brown for the help that he provided on those FIRs, as well as Carrie for coordinating all of this for us. Thanks also to the New Mexico Private Equity Working Group that the Land Commissioner and the Governor asked us to form, which worked, I think, extremely well, and to those of us that served, those of you who served on that group. And to Senator Pete Campos and to Representative Christine Chandler for sponsoring our bills in the Senate and the House. And to Senator Jennings, thanks, Tim, for the assistance you provided. Now I'd like to ask Charlie if he would to fill you in on the details.
Thank you, Governor. Members of the council, I'll be very brief. So we have been forwarding kind of a tracking list to you, and so that continued. There were only four bills that I'd like to highlight from that list today. Steve's already mentioned two of them. The first one, SB 136, was the bill that the council endorsed, which raises the target of, raises the cap on the New Mexico private equity allocation from 9% of the severance tax fund to 11% of the severance tax fund. That did pass with minimal opposition. And I believe it will get to the governor's desk soon. Thank you, Governor. House Bill 83 was the New Early Childhood Trust Fund, which the SIC will manage in consultation with the State Treasurer's Office. That's going to be $320 million of new capital that will try to grow, so it will deliver tens of millions of dollars a year to early childhood projects and programs at the new early childhood
Early childhood
agency.
education and care department.
Thank you.
You're welcome.
Two other bills of note, the HGR 1, this is the bill seeking to take an additional 1% out of the land grant fund. The bill did not pass this year. It did pass farther than it has in previous years. It cleared Senate rules and only had one committee left in the Senate. It did pass the House again. I would note that it cleared rules only after being cut in half. So they were essentially talking about a half of 1% additional distribution. They indicated they were going to try again next year for sure. House Memorial 9. We haven't had a memorial passed directed at the council specifically in several years. We did have one passed this year. House Memorial 9 instructs the office. It's basically, the House is seeking the office specifically develop a strategic plan for investment in New Mexico renewable energy projects. This includes storage, transmission, and businesses related to renewable energy. The directive that they have sent to us asks that the office, in some consultation with the Economic Development Department, and obviously the State Land Office, work together to develop a strategic plan on how we would put more money to work on renewable energy here in New Mexico. We are already doing some of this, but it's more of a one-off and piecemeal. And I think this would be, asking that the council endorse a plan developed by the office. So we'll come back to you and we'll certainly share that memorial in the week of this one, just so you can become familiar with it. We have sent it out before. But we'll come back to you with some kind of plan on how we might accomplish this.
Madam Chair? Yes, Madam Vice Chair.
So, and I was just, Steve and I were chatting before the meeting started, and he was talking about how the appropriation had been stripped from the memorial, or I don't know if it originally had a bill that went along with it. Is that what it was?
Correct. Yes, it is.
So, Madam Chair, I just wanted to let you and the council know that, the land office can provide definitely expertise and resources in terms of building the strategic plan, and I just wanted to commit to that here, because I absolutely support this memorial. I think it's necessary to have sort of all of our ducks swimming in the same direction.
And just to that point, thank you. I appreciate it when everyone is working together on any number of proposals, ideas, and information that can give us an opportunity to either continue a particular strategy or shift that strategy to some degree, and then realize those benefits in the state. I would expect that the two departments in state government who are also working on renewable energy and strategies to develop, three departments actually, and strategies to develop a business response the Environment Department, the Economic Development Department, and the Energy and Minerals Department.
And
And
there,
you should reach out, yep.
yes, it is also a part of the bill that mentioned in it. It does lay most of the directive on the council and the office, but certainly we're willing to work and collaborate with.
And all the other cabinet secretaries are thrilled that you guys are the lead. Congratulations. That's right. Congratulations.
Thank you, Governor. That's my
Understood.
Thank you.
All right, thank you very much. Any questions, comments by members? All right, seeing none, we are on item 3B, the CIO report. Mr. Smith.
Thanks, Governor, and some excitement in the stock markets globally in the last day or so. Finally, the coronavirus that came around a little bit in the stock market. We're only about 5% off the highs, down about 5% this morning. Looks like more. But we've been here before. So some familiar names: H1N1, bird flu, Ebola, SARS. These things have happened before. The economic impact has always been just about the same. We take a short-term hit, and then we make it all back up in the subsequent couple of quarters. So right now, forecasts are for maybe 0.7% of GDP here in the U.S. A little bit more, certainly in China, and some of the areas that are a little harder hit. But we expect to get that back in the next few quarters if the pattern remains the same as how these others, or these other pandemics or epidemics have happened. So I think what the stock market's recognizing is sort of finally that there's something out there. I think it's probably only two surprises. First, it's taking this long for the stock market to react. The second surprise, at least to me, is we're only on 5%. So, as we know, particularly over this last year, stocks have really been pumped up by the Fed on full throttle. Short-term interest rates, the Fed funds rate, anyways, below the rate of inflation, so we have negative real yields. And that's true across the whole yield curve, but particularly at the Fed funds level, it's true. The balance sheet at the Fed is back over $4 trillion. In fact, it's bigger than it was at the end of QE3. So Fed's added even more money to the economy, primarily that's coming through the repo market. They're putting liquidity into the repo market. Fiscal policy is also on full throttle. As we know, $1.1 trillion deficit is expected for 2020 at the federal level. This is a portion of the economic cycle where we expect to see surpluses. We're 1.1 trillion in the hole. And another tax cut is being talked about here for probably next year, it looks like. Maybe get it into this year. So full throttle on monetary policy, full throttle on fiscal policy. The market has just said this is going to go higher given all this stimulus. But I think they finally came around to the fact that we could have an economic hit, likely to have an economic hit due to coronavirus, and, at least in the short term. Probably the greater impacts are going to be on China, at least longer term. So a couple of things are happening there that we should be concerned about. First is this will be 2 percentage points or maybe more from the Chinese economy. That's China's world's second largest economy. So it's a big hit globally anyway in terms of GDP. Some of that may not come back to China. Other countries, because of the disruption in the supply chains, some of these other countries that have outsourced manufacturing to China are making news that they're bringing it back. So South Korea, Vietnam, Philippines have all announced that they're bringing manufacturing capabilities back to their countries that they had outsourced to China. So while here in the U.S. we may see a 0.7% hit and then get that back in the next few quarters, China may see 2 or more percentage points off, but not get that back in the next few quarters. So keeping our eye on that and possible disruption for the rest of the world. However, still, and Marcia will get to performance here pretty soon, still a very good year in 2019, despite a little bit of a sell-off here recently, and she'll go through those numbers with you. Last thing I wanted to cover really was just a little bit of a preview of what's coming next few months, because we've got some big, heavy work to get done this spring and early summer. First, we'll have the triennial asset allocation for land grant severance tax. The last time we did that was 2017. So June of this year, we expect to wrap up with the new allocation. We'll start on that in April, and RBK will present to you the new forward forecasts, long-term forecasts for returns. I expect this will be the lowest set of numbers that I've ever seen in terms of forward-looking forecasts. And it's been certainly the lowest that we've brought to this council in terms of how much we think we can make in the future. So it'll be challenging to find an asset allocation and to make our 7%. And we'll be talking an awful lot about that and some potential things we could do there. Liquidity 2.0, a follow-up to the popular 1.0 report. We'll kind of extend that report. So as you recall, Liquidity 1.0 discussed how much liquidity we might need in a downturn. We modeled at -35 in the stock market. This just extends that to talk about places in the market that we think more capital could move into and be a little more specific about how we can fund ourselves, not only to make new investments, but to rebalance our stocks and other things in the portfolio. So I think you'd be interested in that. We just finished up a new cash flow model for all of our private portfolios. The output for that, I think you'll be impressed with when you see it. I just kind of trotted around the management group yesterday. We'll have a meeting, management group meeting tomorrow. We're going to go through it all, but very excited, very past our expectations in terms of type of cash flow generation coming from the private pools. We'll be able to detail all that for you. Probably next month, but perhaps in April. Last thing is the annual investment plan 2021. We've got started on that. We should have a draft to the investment committee in May, and then we'll bring it to you all in June. And that's my report, Governor, and have to take any questions.
Thank you very much for your report. Do we have any questions, concerns, comments from members? Senator Dawson?
One question really tying back to the earlier part of maybe Steve's report, but if the current West Texas oil is at 51, you said 51.3, West Texas, what do we project the budget on?
52.
Madam Chair, yes,
Certainly.
it's $52.
52?
And then just something to keep in mind, that earlier in the fiscal year, it was higher than that 52 target, so we expected the economists are still projecting it to come in at on average at 52.
Good, thank you.
Absolutely. All right, thank you. All right, the next item on the agenda is item 3C, the first performance report, Smith and RBK.
Thank you.
Thank you, Marcia.
Page 52 in your, I guess I'm gonna do the happy, go backwards and have the happy times. So Vince has talked about what's going on in the market now, but this report is as of the end of 2019, and the returns were quite stunning. Again, we're on page 52 of the book. Fourth quarter of 2019 was strong for global equities, and you can see that at the bottom. In the chart, looking for the quarter, the S&P was up over 9% just for the quarter. Non-US, and then you look for the year, the S&P was up over 31%. So remarkable returns. Falling rates, as Vince mentioned that, really drove performance for the first three quarters. And fourth quarter, it was more optimism that trade environment would improve. If you look down at that chart and look at those numbers, you can see for the quarter that actually emerging market equities was the best performing for that quarter. Again, why? Trade improvements and outlook for trade. Non-US equities in general, that was positive. Also, a slightly weaker dollar helped. Also want to point out the strong equity returns, but look at the fixed income returns on a calendar year-to-date basis. The first three quarters of 2019 were supported by the declining rates. The fourth quarter, the returns were more subdued. For the fourth quarter, the ag was up 0.18, so 0.2%. But look at the returns for the year, 8.72 for the bond market. So you look at equities up for the calendar year, double digits,
20s, 30s, and the bond market up 8.72. Very high returns. And if you look for the calendar year to date, actually commodities were positive as a total, and we have not seen that for a while. But with that said, those returns are very strong, and as Vince hinted, we just finished our capital market assumptions, forward-looking, and because of these strong returns, the expectations for the future are lower. So we'll see that reflected in our capital markets discussion when we talk about asset allocation for both stocks and bonds. Let's go forward to page 55. This is looking at your allocations as of December 31st. The left-hand side is the land grant. The right-hand side is the severance tax. Let's look at land grant first. You can see overweight to U.S. and non-U.S. equity. That was simply market driven. You just saw the returns. So that overweight to your target was market driven. I also think it's important to note, as Barb reminded us, you did a structure change to your fixed income portfolios last month. You can see here that non-core fixed income is underweight and core fixed income is overweight. You made a change that'll be reflected in a future report where a manager was moved, Shankland, short duration, high yield was moved from the core portfolio to the non-core. So that will remedy those overweights, underweights. And then the other most notable on this page is if you compare the land grant allocations versus the severance. The same story is true for the equity overweights and the core versus non-core fixed income. You can see an underweight private equity that simply was a write-down. We'll talk about more for the state private equity portfolio. Still within range, but underweight. Page 56, this is an addition. We will be building out our reporting on the other funds. So going forward with the help of staff, we'll be providing you more reports on the other funds beyond the land grant and severance tax. Page 58 gets to performance and the investment policy review. In your investment policy, you expect the land grant, the return of the land grant portfolio to outperform the land grant policy index on a 3-year basis. And you can see the yes there. The return was 9.2 versus the benchmark at 8.7. Severance tax was a different story. It fell off out of compliance for the 3-year as of September. It was, but we did have that write down in private equity with a significant. But again, that was a change from last quarter. And you can see the returns here. Looking at the quarter, the land grant was up, net of fees 4.09. That's almost 100 basis points better than the severance tax for the quarter. You'll see that was at net of fees at 3.10. And the same story true for the fiscal year to date, the calendar year to date, where significant outperformance by the land grant impacted private equity. Page 59 is looking at attribution. Attribution, this is just for a quarter. I guess a takeaway from this page, as we've always said, is that asset allocation drives your return, and that's reflected here. Your return for land grant was 4.13. The policy index returned 4.25. And you did have you were away from your target allocation slightly. That was additive, but for the quarter, and just for the quarter, your manager value add was negative. Now, further back in the report on page 88, we look at the 3-year, and that's a positive number. So manager value add was positive for the 3-year period. For the quarter, it was not. If you turn to the next page, it's the same, very same information with the exception of one thing. So, like private equity on value add, you can see that the manager's skill was a larger negative for the severance tax than the land grant. And if you look to the far right column, you can see where that is. That's in the private equity portfolio. Page 61, just a couple comments about this. This is looking at the total fund at the top, and then each of the funds individually. You'll notice that tax stabilization and rural libraries are added here with a beginning market value of 0. But let's go back to the top and look at the total fund. And you can see for 2019, net positive cash flow, strong net positive net cash flow, and a investment gain of well over 3 billion. So a very, very strong year. Now, compare that to 2018. So last year, you ended, the market value for 2018, end of the year was less than what you started with. You had negative cash outflows of 72.4 million and investment losses last year of 361.5. All of that coming in that fourth quarter. So a very different look made up for 2018 and 2019. Page 62 is also the build out of adding more information on the other funds. Now we'll go into the peer comparison, and I always say this, but there is no objective in your investment policy for outperformance compared to your peers. But we do provide you that information. Page 64 is looking at the land grant. There's a lot of information on this page. Let's look, again, at the top, you can see your land grant total fund composite, land grant interim policy, and the land grant long-term policy index. Right below that is a peer universe. The first one is the all public plans greater than $1 billion. That's the one we use typically, and you might say, why are we doing greater than $1 billion? Why aren't we doing greater than 10 billion since you're well over that? Well, if you look at the bottom of the page, you can see that the median size for these universes, but for the all public plans, the average size is 15.3. So you're somewhere in between that on average size. So we typically show you against the greater than 1 billion, plus it's a larger universe. And on this, now that we're reporting ranks on a net basis, that 10 billion or greater is a much smaller universe. It's being built out more, but there's less participants. So let's look at that ranking for greater than $1 billion. And you can see that you have a very difficult quarter. And how you read this is your return of 4.09 was well below median for the quarter. You ranked in the 81st percentile. So again, why is that? Well, you have less, you're more diversified than many of your peers. You have less equity. We saw what equity returns did. So you are positioned more conservatively, and not when you have a 30% US equity return, you're not going to capture all of that. So your ranks fell for the short period of time. But if you go out to the 3-year, you're well above median, 43rd percentile. Going out to the 5-year, the 34th percentile, and the 10-year, you're almost in the top quartile. So you are positioned, you have more diversification, you have less equity, but let's also look at this on an absolute basis and say, for the calendar year, you returned 14.63%. That's pretty strong. Any questions about that page, the ranks? I think my favorite page in this whole book is on page 65, and this is looking at the land grant and looking at your ranks on a 3-year rolling basis. In prior years, you were at the top, you were at the bottom, you were at the top, you were at the bottom. The consistency of having above median performance is what pays off in the long run. And you can see, although you fell for the quarter and for the calendar year to date below median, that your 3-year rolling is up there where it should be. You know, not at the very top, but well above median and consistent. And that's the diversification you've added to the portfolio over the long term will reward you. Any questions about that? Page 66 looks at severance tax, again, very close, a little worse than the land grant for the reasons we talked about before. Page 67 compares you to these two universes, and we could spend hours talking about this page, but where this page tells us is that combined, if you look at equities globally, you're underweight on both universes to global equities. You have slightly more to fixed income, although many of your peers here is just core fixed income, where you have your non-core component, which adds income potential for price appreciation. And then on your alternatives, you're about equal to your median peer, and real estate, you have more. So again, the driver for below median performance was not having as much equity in your portfolio. Page 68 is looks at risk and return. Let's look at the left-hand side. That is with the universe of a greater than $1 billion. Again, that's a more robust universe. This is on a net of fees basis. The orange and yellow you can barely see, are your just a long-term policy indexes for both the land grant and severance, and then the green triangle is land grant, the blue circle is severance. You can see for the 5-year period, you fall, land grant falls very much in that northwest quadrant where you have above median return at below median risk. If we look at the land grant, you have 103% of the return compared to the median, but you do it at less volatility. Again, that diversification has put you in a position of being less volatile than the median of your peers, and that's reflected when the red line is median and you're to the left of that. And also for the 5-year, for the land grant anyway, performing above that. For the 10-year, your policy index is right in that northwest quadrant again, and very close to your actual performance. Again, with the land grant being the triangle right at median risk, but above median return. We have this further back in the book on a gross of fees basis as well. It's a larger universe. It pretty much shows the same picture, but we moved this report to a net of fees report. Page 70 looks at all your composites. We'll take a look at this a little bit more in a minute, but you will notice that it was a difficult quarter for your U.S. equity portfolio. Again, I'll talk when we go into that pages, but your equity, U.S. equity portfolio in particular, is positioned to be more defensive. And so when the S&P is up 30%, you're not going to capture that. But you didn't fall as far either when the market fell, and we'll talk more about that. I also want to point out on this page, because we show ranks on the U.S. equity, the quarter, yeah, we fell below median. But you can see underperformance against the Russell 3000, which is the policy benchmark. But look at the ranks. For the fiscal year to date, you trailed your benchmark, but you ranked in the 36th percentile when you compare your U.S. equities to other funds, U.S. equity. That pretty much, and you look at the 3-year, the 5-year, the 7-year, it's all median or above. So it's been a very difficult period for active management, and you've ranked well against your peers. The non-U.S. equity, you can see outperformance there. Core fixed income composite outperformance, median slightly better, ranks long term. And then your non-core portfolio, we talked about this benchmark issue and a 1-month lag there. So you can see some underperformance, at least for the calendar year to date. Your consultants are going to be here talking about your other composites, your alternative composites, so I'd like to go into that. Let's go and talk, since it was significant underperformance in the short term, actually underperformance of the benchmark as well for equities. Let's go to page 73 and look at that composite. You can see that for the performance policy, you want to outperform the Russell 3000 over the 3-year period. You didn't. You trailed it by 59 basis points. And again, we looked at the longer term numbers. But let's go to page 74, and this is where I'll show you that your U.S. equity composite on a risk return has far less volatility than the benchmark. The benchmark is the blue circle. Your US equity composite is the green triangle. So about median return, slightly better for this 3-year period, but you got there with far less risk. I think it's also interesting to look at the chart on the right-hand side. This is a 3-year period. So a 3-year period means 20 quarters, or 12 quarters. Out of those 12 quarters, only 2 of those quarters were negative over the last 3 years. And you can see that when the market, Russell 3000, was negative, you lost less. And you were in line when the market was moving up. So you didn't gain as much when the market was going up, but you protected on the downside. That's the same looking at for the 5-year. In the 5-year, think about that, that's 20 quarters. Only 3 of those quarters were negative. So it hasn't been a market environment. It's been a very strong US equity market. And your position to be more conservative and to protect on the downside. One other number I'll show you is the Sharpe ratio down at the bottom of the left. This is really a measure of risk-adjusted performance. So taking into that account that volatility, you rank 32nd. That's strong. Your Sharpe ratio is strong. So your risk-adjusted performance shows well for that 3-year period. Non-US equities, just go through this very briefly on 77. Just pointing out that your non-US equity portfolio is in line with your policy benchmarks. Again, for the 3-year period on 78, not as dramatic, but you captured the upside on this portfolio and protected somewhat on the downside of that 3-year period. And fixed income, Bart spent time with you on that in last month. You can see for both the core portfolio and the non-core portfolio on page 81 that you're in line with your policy benchmarks. So good there, and on 82 shows those same risk return up and down market captures, which also show very well for your core fixed income, and again non-core as well, meeting its policy expectations. For the remainder on page 84 is your alternative asset classes, and your managers will be talking to you in a moment about those asset classes. Private equity is the only one that's not meeting its 3-year policy expectation.
Any questions, comments, concerns? All right, seeing none, thank you very much. Michelle.
Thank you.
Absolutely, thank you. Good morning.
Good morning, Governor. Good morning, members. I am Paul Chapman, Director of Real Estate and Real Return at the State Investment Council. And I'm here with Seth Marcus from Townsend, and he's going to present the performance report for real estate and real return. Normally, when we perform strongly, I like to steal his thunder and say that the real estate returns are outperforming our benchmark in every relevant measured time frame. So we're very happy about that. And that's largely because of manager selection, but it's also our portfolio composition. We decided to weight our portfolio, just to go back a little bit. We've got 4 food groups to pick from to oversimplify: office, retail, those are your shopping malls, your grocery centers and things like that; industrial, the warehouses, the buildings that Amazon takes to ship your stuff to you; and multifamily. So those are the product types we generally have to choose from. Then there's a other bucket. We are overweighted on industrial, which is the strongest performing sector, and that's a lot to drive our outperformance here. We're significantly underweight in retail. It's not so significant anymore because there's been so many write-downs in the index. We're also significantly underweight in office. So those things combined really account for our outperformance. Where we're heading is, we're not so excited about performance going forward for retail still, office still. And we'll continue to load up on industrial and more so multifamily. In fact, we have a multifamily manager here with us today, FDA, which we'll be talking about today. So with that, good.
Thank you. So, Marcia RBK mentioned that they were going back in time to year end. I'm going to go further back. This is with private asset classes. This report is as of the third quarter, so back in September 30th of 19. So I'll go through this relatively quickly, given it's a number of months since this actual performance was realized. Last slide 4 of the Townsend materials is the typical performance chart. You see the outperformance of both the full portfolio, which is the first bar, as well as the new commitments since 2011, consistent outperformance across those measured time periods, as well as other time periods that we didn't include here for the size of the chart. But consistent outperformance, as Paul mentioned, driven by some of our recent commitments, but also taking a long-term view and balancing the portfolio through both core and non-core investments. The rebalancing of 2011 really addressed that lack of core exposure in the portfolio. Last quarter, when we discussed the second quarter, I talked about a significant increase in the real estate allocation because we did have new fundings from that core commitments. The portfolio did also increase again about 10 basis points, so we're at about 10.9% versus 12% target on an allocation basis. That 10.9 is going to increase again, most likely pretty significantly, given the large core open-ended commitments that we made towards the end of last year. So a new slide that we added on slide 5, it was after the CIC meeting. We talked a lot about the income of the portfolio and why the reason we invest in real estate is for that income driver and collecting rents associated with owning hard assets. So I'll take a minute just to explain these tables here. What we did show is on the left-hand side of the chart is the benchmark income and appreciation. So the total return, but we've bifurcated that into different colors on an annual basis, year in, year out since 2005. Next to that is the New Mexico specific income and appreciation year in, year out. You see where the portfolio had either better income or worse income over the index. The interesting thing is income never went negative. So when we think about the impact of the global financial crisis, the impact on total returns, yes, appreciation, depreciation does occur within these asset classes, assets. However, income has been both consistent and strong. So the chart on the left is a little bit hard to see. There's a lot of different blues and grays now when I look at it. But on the right-hand side, we show the combined income and appreciation over different time periods. So on the left-hand side, again, the Odyssey index, it's a 7.6% return since 2005. The New Mexico portfolio is a 7.6% return since 2005. But the Odyssey had a lot more income component of that. And that's typically 70% of your returns is typically driven by income within real estate. The lower income number, the 3.4% income versus 4.2% appreciation for New Mexico since inception bar, it was really driven by those early commitments to non-core real estate, where we had no core portfolio, we had no core exposure up until 2011. So when we look at the right-hand side of that chart, the Odyssey since 2011 and the new commitment since 2011, the income is 20 basis points there. So strong income returns out of our portfolio and in line with the index and about where we anticipate them to be. But you see outsized appreciation, and that goes to Paul's comments about manager selection and allocation selection and portfolio construction. So we don't expect a 14.2% return out of real estate. That was an anomaly. These last 15 years have been extremely strong. But we do anticipate income to be a larger component of the return going forward, about 70% of the return coming from income, with the remaining 35% coming from appreciation. The last slide I'll talk about, and like I said, there's a lot of materials in here, but I'll keep it brief, is slide 6 in the Townsend report. And here it shows again the pre-2011 commitments, all in the non-core, and then the rebalance at the end of 2011. You'll see 2019 was our most active year. A lot of that is driven by, well, first off, the lower bar, the blue bar, has been a consistent non-core commitments, within one or two commitments that we've made on an annual basis. What we did do in 2019 is make significant core commitments. We did a rebalancing out of the equities portfolio into real estate. That's addressed here with a large $300 million commitment. We made 2 additional core commitments late last year, and that's driving the over allocation as it looks like on slide 9 or in 2019. 2020 going forward, you see, we anticipate consistent non-core commitments. What is not captured here, and another reason for that increased exposure in 2019 was the TSR dollars that came in and put out immediately. So as those come in, those are not accounted for here. We just don't really have a good sense of when those may occur. We address those as they are possible. That's the last chart I was going to talk about. There's a lot of other information here, a lot of it you've seen before, but happy to answer any questions on those.
Any questions for Paul?
Thank you, Madam Chair. Just a quick question on the return. So did you say the 14%, what period was that referencing?
So since the new commitments since 2011, so since from 11 till now, just that portion of the portfolio was 14.2% return.
And the reason why we use 2011, that's when Steve and Vince came on board, that's when Townsend came on board. So that's really when the whole real estate strategy pivoted.
And just another quick question on the 1 year return, is it 5.6%?
Correct.
So approximately what portion of that relates to the income versus the asset appreciation?
Sure. So over the 1 year, about so on a gross basis, the return was about 7.5%. So looking at it from a gross to gross, it was about 3% of that, 3.5% of that came from income.
Okay. Thank you. Any other questions?
Okay, let's flip over to the real return portfolio, and I'm just going to remind the committee members that our real return portfolio consists of financial assets, that's 20% of the 12% allocation, and 80% in real assets being ag, timber, energy, infrastructure. The financial asset bucket, most of the space there is taken up by a large commitment to MLPs. We just started, or Townsend just started, was the second quarter of 19, combining everything together so that they're looking at aggregate returns of our entire real return portfolio. Part of that, they're just looking at real asset. I think the big takeaway for me as I look at these numbers is, and you can talk about performance, but where are we going with this portfolio? As the portfolio grows, and ultimately this will be a $3 billion portfolio, we're roughly $1.6 billion right now. As that denominator grows, expect to see timber and agriculture become less and less important. Right now they're at sort of 10 and 12. They'll become sort of more like 8 and 10, and that the growth will really come in those two other buckets, energy and infrastructure, with probably an emphasis on infrastructure. So we have an infrastructure manager here today as part of that plan to expand our infrastructure exposure in our real asset portfolio. We'll take it.
Sure. So just to elaborate a little bit about that allocation. So of the real return portfolio, 80% is in what we consider real assets, so it's the timber, infrastructure, energy, and ag portfolios, and the remaining 20% is in financial assets. Those financial assets, as Paul mentioned, are primarily MLPs today. There's a lot of volatility, so it's a little bit of a mix of a very different strategy between the financial assets and the real assets. The real assets are long-term, 10 plus, in some cases 20-year funds that create value over time and generate a significant amount of income. MLPs have the public market volatility, and therefore you see on page 5 the volatility of returns in the real return combined performance. We have a negative quarter, a negative 1 year, positive 3 year, and sort of a relatively flat 5 year. And then more consistent returns on the real assets page. On the real assets portfolio, due to that long return outlook on those portfolios. MLP weighting is going to come down. We've made additional commitments in the financial assets portfolio to real estate debt, a little bit in both of those two funds, both open-ended. So those will be more longer term outlooks, so to balance that MLP volatility. So the first two slides here, slide 4 and 5, look at the real return combined portfolio. Beyond there is the real assets highlights what we typically provided in the past. And the portfolio today really marks a well built out infrastructure, timber, and ag portfolio. In 2019 we made 4 commitments to to these infrastructure and energy commitments. No timber, no ag commitments. Those were made to both follow-on managers and a couple of new managers. As Paul mentioned, we have Icon here today as a new infrastructure manager to build out that portfolio further. So similar to real estate, I talked about that this is a more active vintage for real assets portfolio, and that's on slide 8. You'll see 2019, actually it was 5 commitments for $400 million, relatively high compared to the last 3 years. And that's really based on the opportunity set that was available to us, and also the number of co-investment commitments that we made follow on to existing funds. Performance is captured on slides both 9 and 10. 9 shows the annual performance versus the expected return generated or produced from RVK. And you'll see a slight lag year-to-date September for 2019, 6.475. That lag is primarily being driven by some volatility in the 2019 calendar year from energy. So I talked about it in the past, but when we think about the real return or the real asset portfolio, infrastructure has been driving outside returns. About a 10% positive return from infrastructure, with the other 3 asset classes being either much lower or negative even, depending on the time period. So energy continues to be relatively volatile. In 2019, I think the year-to-date number was approximately 3% return out of energy. In 2017, the annual return was 18%. So think about that 15% difference in just a 1-year return between the energy portfolio. On slide 10, we show the contribution to returns over the 3-year period. And again, you'll see over the 3-year period, strong performance out of both infrastructure and energy, with timber, ag, and there's a slight allocation of other being relatively small, positive, slightly positive or slightly negative. We did dive deeper into the timber and ag performance at the investment committee level. I'm happy to discuss those, but ultimately, within the timber portfolio, each of those investments is slightly above cost when we look at an equity multiple perspective. So those are still creating value, making investments into the timber, executing the timber strategies, and are held sort of at or slightly above cost. And agriculture's a little bit of the opposite, so it's held either slightly below cost. And some of that is driven by commodity pricing, exports and imports through some of the tariffs experienced in 2019, but relatively also some currency exposure within that portfolio. We've got an exposure to both South America and other currencies that have depreciated relative to the US dollar. Again, I'll stop here. There's a lot of other materials in here, but open up to any questions.
Council. Thank you, gentlemen.
Well, thank you.
Next, we have a coaching report for National Private Equity. David and Richard.
Thank you, Madam Chair. I'm here on behalf of Mike Klugmeyer of Mercer. As a reminder, this is the National Private Equity portfolio third quarter performance through September 30 of last year. I think Richard probably will start on diligent page 198.
And I plan to go through national program pretty quick and then spend a little bit more time on the state program, since you already heard from our RVK report that there was some valuation impact on that. So on the national program side, for Q3 performance, it was slightly positive, but I call it relatively flat compared to the gains that we've been seeing in the prior quarters. The net asset value basically didn't really change much. And when you look at the detail of the individual funds, I mean, there's a lot of idiosyncratic reasons of why gains were up or there were losses. For example, there's been a number of IPOs in the portfolio. Some of those portfolio companies were marked up because the publicly traded price was up. Some of them were marked down because the publicly traded price. There was also some performance where some of the companies outperformed and were marked up, and some underperformed and were marked down. So it was really kind of a wash of different things that happened during the quarter. When you look at it from a 1-year perspective, though, there's been a 10% return in the national private equity program. It's really been driven by buyout funds and growth funds. which have both generated over 11% returns on a one-year basis. If you look at the chart on the bottom, you can see the rolling 10-year there has increased to 11.9%. We also put in what the funds with vintage years 2009 before return is, which is 10.5. So you can see an impact of the newer fund commitments on the overall performance of the portfolio. On the next page, page 5 of the performance report, one of the themes you've heard me talking about in the prior performance reports is distributions, and how we'd like to see more distributions come out of this portfolio. And we had a really weak Q1, which is no longer on this page. Distributions did come back Q2, Q3, but they really came back strongly in Q4 with almost 200 million of distributions. So we ended up ending the year 2019 with 454 million of distributions, which is great. You know, we want to continue to see distributions given where we are in the market cycle and the strong markets that we have. Turning to page 7, page 6 has more detail on the gains and losses in the portfolio. Page 7 shows the performance by vintage year. Really not much change in the relative rankings by vintage year on the individual years. But if you look at the remaining value column, that's what we're focused on right now, where, you know, especially the 2009 before, we'd like to see that value come back in cash with those companies being sold. And even the 2011 and 2012, we'd like to see more realizations there. The next page is the public market equivalent, where we calculate on a time-weighted basis, comparing the 10-year net IRR of the program to various public indices. The gap has been closing as of late. You know, for example, compared against the Russell 3000, it's now 1.6, whereas last quarter it was about 2.5%. And then on the national program, I'll end on slide 9, which shows where we're tracking according to the private equity strategy. We have a commitment range of 300 million to 400 million. We haven't made any commitments in 2020. We're looking at bringing one potentially next month for the national program. In 2019, we were right within that range with 5 commitments for 400 million. On a strategy and geography basis, we're all within the ranges that we've talked about. On the concentration guidelines too, that's something that we're mindful of when we size potential managers. We only have one general partner that's greater than 10%. And I think, you know, the point at the bottom too, you know, the portfolio has 115 active funds. We've been able to do a good job of not having that increase significantly with pursuing a relatively concentrated portfolio strategy since 2011. The 2007 and older funds have an aggregate remaining value of 120 million. Just to give you a sense, 2 quarters ago that was 173 million. So we've gotten over 50 million back from those older funds, which is something that we're still focused on. So with that, I'll open up to questions on the national program.
All right, sounds like we can move to New Mexico.
All right, let's move to the New Mexico program. I'm going to move to page 4, which I'm not sure what page that is.
225.
Okay. So we did have a decrease in performance in Q3 in the New Mexico program. It was really mark-to-market valuations on 3 of the large holdings. One of the things we've talked to the council about in the past is the concentration in the New Mexico program with, you know, to a number of different companies. And it just so happens that the 3 largest holdings that you have exposure to in the New Mexico program were written down in the quarter, all for different reasons. And I want to emphasize this is a mark-to-market write-down, so it's not an impairment. It's driven by different market events. We talked about one of the companies going public in the last performance report. It was marked to the publicly traded price as of September 30th. That probably is going to go up as of December 31st because the stock price went up. But then since December 31st, that stock price has gone down, but not quite to the September 30th value. So whenever you have a large position that goes public, you can expect some volatility in the performance of the state program. You can see it did impact even the overall return went from 2.5% 1 year ago to 1.1% There's actually a small gain in the fund investments of about $1 million, driven by a realization in one of the funds there. But really it was the co-investment funds that drove the performance in Q3. You can see that on the chart on page 5. When you look at the net asset value going from 408.9 to 364.2, it's really driven by that loss of $45.7 million, which was driven by the $46.8 million loss from the co-investment funds. And then turning to page 7, I mean, the write-downs did impact a lot of the different benchmark rankings where they did fall below median in the 2007, 2013, and 2014, which are now tracking below median because of those market decreases. And then because of time, I'll just skip ahead to the economic impact, because this is an important part of the state program, which is page 14. 235. So 73 companies based in New Mexico have received investments, or 3 over the last 12 months. This doesn't include the one that we talked about at the last meeting, where Anzu Partners invested in TX Bio. That one will be probably at the end of Q4, so hopefully in the next report we'll have that one. At the SIC level, from the severance tax, about $268 million have been put in those New Mexico companies. When you include the investment amount from the funds themselves, that number increases to $362 million. And then 19 million of that was invested over the last year, to give you a sense of what the activity was over the last year. We also track companies no longer located in New Mexico, which is 3 of them, and companies that have received New Mexico government incentives, which is 19. And then on the next page is the jobs. We actually report 2 different jobs numbers. One is the total jobs of the company, because you figure when you make an investment in a company, you're supporting the existing jobs that are in place, which is 1,172 or 790 for those companies that are still active in the portfolio. And then we also track job growth, because with especially venture capital and buyout, we expect jobs to grow over time if the fund managers are doing the value add strategy that we hope they do. And so the job growth has been 412 since inception on all the companies. And so that's looking at it from the first time a fund manager of the SICs invests to where it is now. And of the unrealized companies, that job growth number is 252.
And just as a reminder, I know we've said this before, but the reason we have 2 columns with currently held versus sold and written, you should look at that latter category as a static number. The funds cannot give information about these companies once they're sold, so we kind of just hold it right where it was to not completely zero it out, but the council should do it.
So what we hope is it continues growing even after it's sold. We can't track those numbers.
Any questions on the New Mexico program? Other council, yes.
So this is broader than that. You mentioned distributions in excess of 400 million real assets. Do you then look to place that in real assets? Does it just go into the general funds that we have available? How does that work?
Yeah, so the distributions, the number you're referring to is the national program. Those distributions come in, and then we use that money either to fund capital calls, or it's actually dependent upon the asset allocation. But what we like about the distributions is this is an illiquid asset class. So you're talking about mark to market based on GP valuation. So a distribution is really, at the end of the day, the only way to see whether the value was actual or not.
And Mr. Messina, is it okay if Mr. Smith also answers the question?
Of course.
So the cash flow model that I was telling you about, when we go through that next month or April, whenever we get it to you, that question you asked Dave about where does that money go when we get it back, we'll show you in a picture where how it comes in and how it goes out. You could be impressed by how this chart looks and how that model functions. You had a question on the market? So quarterly, our managers market our private positions to, in some of the public positions they had to with the current public markets are trading. So they try to get a valuation quarterly. They get a valuation on audit.
Mr. Treasurer.
Thank you, Madam Chair. On your slide 6, bottom left corner, you talk about the top building analysis. What do you think's going on there?
So when you look at are you on the state program?
Yeah.
Yeah, so when you look at it, there's a number of different tranches of the co-investment funds. What's going on is the 3 largest holdings are actually spread across those different tranches in the co-investment fund. So the write-down in those 3 companies impacted all those tranches.
Any questions from folks on the phone on the New Mexico program? Thank you, gentlemen.
No, I don't have any questions.
For me. All right, thank you. We're going to move to agenda item number 4, investment matters. Over to our investment committee chair, Ms. Rice.
I want to reiterate Carol's remark. Everybody is invited to attend the investment committee meetings. We actually go through almost the entire agenda that we did here. We go through at the investment committee. So many of these things have been addressed. We were very happy that Commissioner Garcia came at the last meeting and we invited her to come. We've already gone through the consent agenda item on HPS. The other investments were all approved unanimously for presentation to the State Investment Council, as well as the purchase of a risk management system. We've had, in addition to things that were not brought before the SIC today, I'm promising you they will in the future. We had a robust discussion regarding crisis investing power. And this was brought to us from the governance committee for our review and recommendations. And it was sent back to the governance committee for further modeling and presentation to the SIC at a later date.
I left before that decision was made, so I'm happy to hear it. Any questions on the investment committee reports? All right, with that, we're going to move to agenda item 4B, and Paul, I'm just going to turn it over to you.
Thank you very much. So I have Jack Koch has joined us at the table here along with Seth from Townsend. We've got Rishi Paveri from ICON, as well as Ian McLeod. And they're talking about the ICON infrastructure $75 million commitment that we are proposing for your approval today. We spoke when we were doing the performance review that one of the spaces that we're really trying to build out in our portfolio is infrastructure. This is kind of an interesting niche for us because a lot of the commitments we've made are with the really big mega funds, the Blackstone Infrastructure Fund and the Brookfield 4 Fund, and those companies are really set up to make investments, to write equity checks of $500 million, $1 billion, sometimes $2 billion. So as we look at our portfolio, we were trying to find a way to sort of zero in on some more mid-market type investments, and we happened upon ICON. And ICON has had extraordinary performance, so much so that almost all of their existing investors re-up. So it was very hard to find space in their fund for New Mexico State Investment Council, but pleased to report that they were able to get us $75 million. Clay did the underwriting, met with the team, Clay from my team down here. So Clay, you want to say a few things about it?
Sure.
Yeah,
I think, as far as how they fit in our portfolio, Paul's covered that a bit. In addition, we are hoping for some more European exposure. Some of our existing managers have a little bit more currently in South America and North America. And as such, ICON really takes a couple of boxes for us. I'm going to leave them to discuss their own what they do. They'll do much better than me. But I do want to cover a couple items of where did we think that they really excelled when we compared ICON to a few other folks. Standard items you would expect from most managers moving forward. Very strong performance, very strong team. But a couple other competitive advantages that I'll quickly highlight.
they've really done a great job sourcing assets on a proprietary basis. So what does that mean? This will become applicable for FPA here in a second as well, is there's a lot of assets that go out to bid to the broader market, and everyone kind of throws in their hat to the ring, and whoever pays the most wins, typically. Icon's done a really good job trying to find off-market deals and or deals where when things go out to bid, they also have a qualitative aspect to them, and people aren't just looking for whoever pays the most. What that allows them to do is really get a good deal on the front end and basically protect your basis from less downside risk and also give you more upside. And so we look for that in managers. It's not easy, and it's kind of a tough thing to look for, but we really think that these guys have done a really good job compared to others that we chat with. A real emphasis on downside risk within the culture. We find this in a lot of the infrastructure managers that we bring, but these guys exude that as well. Occasionally we will bring someone that's a little bit more opportunistic and looking for a lot of upside, and you take some commensurate downside risk to get that. We didn't really feel that was a risk or part of the culture at Icon. And then they also have, which is fairly unique to infrastructure managers to a degree, is a really good proven history of being able to exit the assets. These are really long dated assets. These are things that can be held for a decade. And infrastructure is still a relatively new asset class and institutional portfolio. We're fairly, ahead of the curve just by starting in 2001. And so the fact that they've already exited approximately a third of their assets that they've invested in is really a testament to their ability not just to get good deals, but also then to take a full cycle into the sales process. The main risks that we see with Icon is Paul Milan, who's their CEO. We really see him as critical to the process. We expect him to remain around. If anything were ever to happen to him, we would be having a lot of phone calls with Rishi. But that is something we just like to highlight when you have one person who is often the founder and still critical to the process. So that's something we were able to get comfortable with. We think they have a really good team. Paul has done an excellent job sharing ownership. So we think a lot of those risks are mitigated, but something we want to bring forward. And also as a historically European-centric fund, they're going to remain that way. They do have the ability to up to 40% in North America. They've taken things when they went into new sectors, new geographies, very slowly, very carefully. They have exposure and history here. So again, something we looked at and asked questions on, but ultimately we're able to gain comfort with that. Of course, the recommended investment in Icon is in compliance with all investment policy statements, parameters. And so with that, we will go ahead and turn it over to the Icon team unless Townsend has anything they need to jump in.
All right. Well, thank you, Paul. Thank you, Clay. Thank you, members of the council, for the showing for me here today. Our first trip to Santa Fe, all the way over from London. Icon is indeed a specialist manager investing in private infrastructure investments. We are based in London, that's headquarters, but we have offices in Germany, in Toronto, and most recently just opened again in New York. As Clay mentioned, we focus on the mid-market investments in infrastructure, and that's because we see more opportunities by number, and we see less competition against some of the larger funds that Paul mentioned, but also some of the direct investors out in Canada and sovereign wealth funds. So we play in a market where we see opportunity to secure transactions at that time. Our differentiation, I mentioned this kindly, is indeed around our origination strategy and the execution of that strategy, being focused on bilateral and proprietary deal origination. Many managers will talk about that. We execute that as a strategy. All of our 9 investments that we have made in Icon 4, our current fund, we have executed those transactions, done our due diligence under exclusivity. That strategy has also proven to deliver strong returns. Our returns that I think are in your papers are top quarter across all of our funds. And it's our combination of strong returns, but also investment discipline that indeed has seen
high re-up rate across our multiple funds. We have a team of over 40 professionals. We have grown significantly, as you would anticipate, since the formation of our business in 2011. But the core of the team, founded by Paul Mann, has remained the same. And we work very hard to maintain our close culture of communication and teamwork that is critical to our success, and is demonstrated by the very high retention rates of our team. We have hired selectively and strategically, particularly recently in areas of compliance and ESG, also in specialist asset management resources, and also specialist third-party advisors to help us in new sectors and geographies. For Icon 5, which we are fundraising for today, we will be repeating the same strategy. Mid-market, the same focus of sectors, the same bilateral investment thesis, with very much a focus on downside protection on capital security. That's inbuilt in our DNA. And we're raising Icon 5 for the very good reason that we have a strong pipeline of opportunities. We have 7 transactions that are in exclusivity today. And we expect to deploy within a time frame of 3 to 4 years. One of the things they mentioned is we have increased our resources in North America, in Toronto and New York, and we are looking to increase our investments. In that context, we are looking to add US-based LPs to our LP base. In that context, we would very much welcome New Mexico as a new investor and hopefully a long-term partner for us. Thank you very much.
Thank you, Mr. McLeod. I'm going to turn it over to questions from the council for Icon or our.
If you, Madam Vice Chair, if you take a look at page 282, would you take half an hour or so to explain the fund legal structure? I'm just joking. That's a pretty funny slide.
Yes. Thank you. I've got one question for clarification to me on your infrastructure facilities. You mentioned, of course, renewable power, oil and gas, and so forth, but you mentioned social infrastructure.
Yes.
Could you explain to me what that is?
That includes assets like telecoms. Within the telecom space, you'll appreciate only very small elements of that is applicable to infrastructure. And similarly in healthcare, one could also see education falling into that bracket, but they need to have the very specific infrastructure investment characteristics that will fit our definition of infrastructure. So that means we need to have real assets. We need to have a strong market position, often supported by regulatory underpinning. We need to have the right cash flow characteristics. We need to have the right barriers to entry. So it's that; those are the opportunities that are captured within that.
This is something we don't normally see in our US-centric investments. This is very much more of a European strategy, is to go after some of these social infrastructures.
Well, no, it's just that you listed on that. It goes on to say after social infrastructure, you list healthcare.
Yes.
And you also list telecom. So it's like, and then you say, well, that's part of the social infrastructure. So I'm just trying to figure it out, but that's okay.
Yes, I would describe it as part
so the
of
only thing you
social.
really added was maybe some educational issues.
Yes.
That wasn't specifically identified there.
True. We could also look at some PPP style assets, but in reality, we haven't.
Thank you.
Member Tejas.
Thank you, Madam Chair. My questions relate to page 258. At the bottom of the page, there's a schedule there, I think comparing Icon 1 through 4. And if you go to the column that says gross IRR and net IRR, could you just kind of comment on what essentially happened with Icon 1, where you saw a pretty large IRR there, and a pretty significant change to 4, And then on top of that, just if you can comment on Icon 5, that is expected to return 10 to 12% net of all fees. Like, how do those relate if they do it?
Do you have those return numbers available?
I do, I'm familiar with that. With the issue. Icon 1 was a special situation. It was related actually to the formation of our business in 2011. And it was a very short dated, only a 4-year fund with 3 existing assets, like a secondary fund that did indeed perform very well. But it was a special situation. Icon 2, 3, 4 are really comparable funds, I would suggest, in terms of Icon 5 and what we expect to deliver. Because those were the funds that were, Icon 2 was our first fund that we raised as an independent business. So I think those returns are more applicable for us going forward. Icon 4 is very early days. We opened Icon 4 at the beginning of 2018. So it's very early days with that fund. We typically take a pretty conservative approach to our markets in terms of valuations. But yes, we're confident in terms of delivering the returns for Icon 5, as you mentioned.
Thank you.
Thank you, Madam Chair. I guess this is more of a question. Clay, you brought up the key person, so to speak. So I guess it's a question more for Evan. Because there are comments in here where if Milan leaves, that the actual investment could be suspended for a short period of time until they figure out where they want to go next. Is there a provision that you can put in their contract with us that we have a little bit more, I guess, surety on our part, more security on our part? That, I mean, their target rate, their hurdle rate is already low, 6, but you know, this could even grow further than that. So.
I'm gonna ask Rashid's question. The key person is tied to 2, is it not?
It is.
So the key person is actually a bit weaker than you're saying, because it's not just Milan leaves, it's Mr. Juan and one other. And so there won't be a suspension unless 2 people trigger. We have asked in the legal process to affect a change with that. I am respectfully not optimistic that will happen. So I think that what you're focused on is a risk, which was identified, which is on balance. The positives probably outweigh that risk, but to answer your question is, I'm probably not going to be able to rewrite their docs for the one and done close on March 26th or something like that. I get a lot of fun, so forgive me if I don't have this right, but so there's a risk if Mr. Milan leaves and someone else does not leave as well, you might get a suspension. 2 people leave, you might get a suspension. I sincerely doubt 2.
You do have a no-fault removal clause in the documents as well. It's a little bit, it's at the higher end of what we typically would like to see it. We'd like to see 66%. It's at 75%. So the reality is through our underwriting and our history of underwriting Icon and with them, recognize that he is very much engaged. He truly views himself as the to continue on with the series. So in the unlikely event that something would happen, you still do have a no-fault removal clause that does provide some protection. But as we've highlighted it in our documents, and it's highlighted as well, it is a risk.
It's highlighted in here. He owns what, 40%?
Yes, approximately. To pick up on the point that Evan made, that the clause is triggered by the departure of Paul and myself. I also sit on the management board alongside Paul, and he will learn from the beginning, and Gary Legacy, so the 3 of us who are the executives who are responsible for running the business. Paul, no question, is important for the firm. He was the founder of the firm and remains the senior partner. I would highlight that I think that risk has certainly reduced from where we started, no question. Indeed, if you look at the Icon 4 portfolio, Paul was actually not responsible for the origination or execution of any of those investments. So I think that our business has matured, as you would anticipate, to be significantly less reliant on people, and that is, I think, fairly reflected in the EMAC clause as presented, that we have had that same clause now for both Icon 3 and Icon 4 already.
You know, I hate to interrupt, this is Tim, but I have to go, so I'll have to catch you all a little later. Thank you, sorry.
See you, Tim. I just noticed on the net return comparisons, that's why I look back at the key person.
Yes.
Because, when you look at your peer group average and how you chart that, it certainly shows that the manager is capturing a little bit more than the group, so to speak, in that graph. That's, is that a correct assumption on my part, or?
I don't know, I'm not familiar with the graph that you've got in front of me, so
That's
forgive
crazy.
me.
I can speak to that, Sean. So they are in line with their peers at the very low end, and then above, and actually at the target return as well. Where they tend to be a little bit more expensive is in that range between sort of 8% gross to a 13% gross. And that's due to the lower hurdle rate. What I would say is that they have achieved above that 13% gross historically. They are targeting a 13% plus return. But there is that potential for to be more expensive than their peers in that range.
I'll say, when we look at that, and their history has kind of earned them the right to have the 6% growth instead of an 8% growth return. And a couple options they have, because they've successfully grown their team over time with each consecutive fund as they've taken on more and more investments, which isn't always the case with managers. So they have a large and well-staffed team, and so they kind of have a couple options. They can either make sure that their potential carry is a little more secure by doing something like lowering the preferential return, or they can grow their fund size and take in more base fees to make sure that they can maintain their team size and keep all of the very talented people that they have. One major reason why we went with Icon is with their past performance, they could have went 1 billion, 3 billion, 6 billion, 10 billion, and they didn't. They've maintained very strict discipline on their mid-market fund set, or their mid-market target and niche, which makes it so they have a single fund close, which makes it very difficult to get in, which makes it so they have near 100% re-up rates. And we would rather see that change on the pref return than we would see them double up the fund size. So I think that's something we definitely looked at versus peers, but ultimately I think we kind of recognize that business move as well, and we'd rather have them see a lower fund size and a lower pref than a higher fund size and chasing differentiated deals that they have.
Somewhere in here, I haven't found it yet, but you made a comment about storage. And the first time, it's on your page 14, page 271. You have from a sector perspective, the portfolio has exposure to storage, 21.9. Is that like old people like us? Is that healthcare? Actually, storage. I mean, that's right.
That's definitely not healthy. It is, I imagine that is referring to our business in the Netherlands, which is an oil storage, which sits in Fund 2. And we have another oil storage that's in Fund 4, that could be that one, which is small, but it's a long-term contract with it.
Sorry, it just kind of.
Yes, I appreciate it.
Any other questions? Do I have a motion?
Based on the recommendations of the Council Investment Committee, Real Return Advisor, the Townsend Group, SIC staff, and general fiduciary oversight of RDK, I move that the State Investment Council approve a commitment of up to $75 million to Icon Infrastructure Partners 5, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we have a motion and a second. Any further discussion on that motion? All those in favor signify by saying aye.
Aye.
Those
Aye.
Okay,
Aye.
all those opposed? Any abstentions? All right, that we have a successful motion. Thank you very much.
Great, thank you.
Drop them dead.
All right, agenda item 4C. FDA.
Okay, so again, just a little bit of context here on what our strategy is as we continue to build up the real estate portfolio. And we've got food groups to work with, and but really 4 is 2, because retail is just in such a difficult spot, and office is so capital intensive that it's such a market timing sector. So we really feel that we need to spend our time developing our portfolio exposure to industrial. We're pretty good on industrial and multifamily. And right now, we're a little bit under allocated on multifamily, so we brought one forward in the last couple of months. We have another one that will come forward in the next couple of months. So that's really going to help us get above our benchmark in terms of exposure to multifamily. And think about multifamily as it's fairly low capital expenses. Good multifamily can always adjust to the market, so if you buy good product, it can always be leased and generating revenue. So we think it's a great strategy to weather a storm. Again, on this one, Clay did most of the underwriting. He met with FDA a number of times, met with their senior staff and some of their operational people, visited some properties, and did references with other LPs that FDA's worked with in the past. All of that was very favorable, but Clay, why don't you jump in?
Sure. So I'll kind of run the same thing we just did with Icon here. I'll leave the bulk of the discussion to them to just cover a couple of items of why FPA and other multifamily managers that we looked at. So again, strong performance, strong team. Continuing theme you'll see with the multifamily manager for the open-end fund we brought last week, and another one which we'll be bringing in April, is vertical integration. These guys, which basically means they integrate their investment, their property management, and their construction all in-house. It helps reduce red tape, speed up the process, and really kind of all be together and singing from the same note sheet when it comes to business planning. A couple other key areas. I already kind of referenced it in saying I was going to talk about it at FDA. They're very good at sourcing deals and being very aggressive, falling in love with deals, and finding deals on a proprietary basis. Sending out a lot of offers to things that are not yet on the market, finding out who the owners of buildings are when they drive around and something that's interesting. Trying to get into complicated and messy situations so that they can come out with a good basis on the front end. And then also something that just kind of stood out as you walk through, and we had the opportunity to do property tours with multiple managers. And as you walk through the various property tours with Greg and some of the various members of his team, they, I would say more than anyone, really hit on so much. We want to be the best value in the neighborhood. We want to be the best combination of both quality, but yet at a price discount to what is in the immediate area, particularly relevant to A properties, which we think is a good mixture. When we're a little bit later cycle, we're looking for people that in a down market can protect and find buildings that are still going to fill up and still stay full and aren't going to have to drop their rents as much to do that. We think these guys are going to be really successful in that area should we run into a recession in the period of this fund, which is a 10-year plus fund, so that's a good chance that may happen. The primary risk I'll point out is Greg is the CEO, and we still see him as very critical to the business. He has majority ownership in the fund. Greg does have a very strong key man provision tied to him, so it is singularly tied to Greg. It's not Greg and one other. It's singularly tied to him. We appreciate that. Even with that, the amount of retention on their team, if you go around the people on their investment committee, they've all been there 15 plus years now working together. Yeah, 20 plus years in maybe. So yeah, it's still very impressive the amount of time that all the investment members have been together, worked together, and experienced on the team. But it is something that we're always looking at ownership structure among anyone that we look at, and that's a very common standard risk we kind of see as we bring forward, not just with these guys or Icon, but pretty on. So, of course, the recommended investment in FPA is in compliance with all investment policy statements and parameters. That'll pass on to Townsend for anything I missed that they need to make sure they're covered and on to.
Now, I forgot to introduce Greg Fowler and Hannah Moriarty, so from FPA, so welcome, thanks for coming.
Want to start?
Yeah, go ahead.
I'm Greg Fowler, and I am the founder of FPA. I started, I was City State undergraduate, and started with a fourplex, 4 units, and did about 20 buildings on my own. I was a commercial real estate broker, and then started syndicating deals in the early 90s. We raised our first fund in 2000, and we've now raised 10 funds, and we've had the first closing on this, which will be our 11th fund. Another thing that we didn't point out is this is a very low fee fund. So typically in real estate, you're going to pay 1.5 and 20, so about 380 to 450 basis points, depending on how much debt deal costs, et cetera. This fund is 7% of the NOI, so it's under 80 basis points with no promote. And this fund is really a defensive fund. So we're trying to deliver a 10 net fee return, but with only 50% leverage. So typically we're buying these apartment complexes. They're all in A location, so the core comes from A locations. The plus means we'll buy older buildings. So if you look, there's a map in there, but basically we're going up and down the West Coast and the East Coast, and then major markets in the center of the country, like Austin, Dallas, Houston, Nashville, Chicago, Minneapolis, Atlanta. But generally it's East and West Coast, so it's about 25 major markets where you see most of the growth. The average household income there is we're targeting for about $125,000. But our buildings are typically affordable for people that make $50,000 to $80,000. So if you look at a pyramid, most apartments that are being developed today are Class A plus, and in most markets you need to make about $150,000 plus to afford a 2-bedroom apartment. Our people can make 50 to 80 grand, so we have much more of a wider tenant base that we can attract. And so a lot of the demand with new construction is on the very top of the market, and there's been some concessions because of that. But you want to focus kind of like at Kimpton hotels, where they're a boutique hotel. Or instead of being the Four Seasons at $750 a night, we want to be the Kimpton Hotel at $250 a night. So we're really trying to get the recent college graduate, the person that's in back office accounting, the front office person, and be able to put them near the job centers. Company was founded in 1985. We have about 1,000 employees, about 800 are at the site level, about 200 off-site. We're a little bit unique in that about 70 people share and promote on our value-added funds. And in the Core Plus funds, about 100 people share in the asset management fee. So we have really good retention because people can make more money. The other thing by doing our own management is we control how many properties each regional property manager has. So each person's limited to about 8 properties. The third-party management typically will have 15 to 20 properties, which if you have a great manager, just spreads them too thin. We have offices across the country, San Francisco, where Hannah and I are. We have about 20 people there, about 60 people in our Orange County office, which is our property management space. And then we have regional offices in Denver, Dallas, Atlanta, Chicago, Minneapolis, and DC. We have 6 active people across the country, and as Clay alluded to, we write a lot of off-market offers. So last year we bought approximately 50 deals. We wrote 3,000 off-market offers. So we write on every listed deal. So anything that one of the major brokerage firms, C. Richard Ellis, JLL, Marcus Goldschap has, we write offers on those. Our success rate on those offers is about 0.1% of 1%. But our off-market offers, so it's about 10 to 15% of what we buy. But our off-markets, we get about 1 to 2%. So we still get a lot of rejections. But what we're trying to do is find buildings that have rental upside or expense savings. A lot of times we're buying from long-term owners whose strategy is to keep the rents low, to keep the building full, but by doing a renovation, like a boutique hotel, we can bring in, a higher quality renter and raise the rents. We're typically buying these deals at an average of a 5% return. And our goal by year 5 is to get to a 6.5 to 7% return. And by year 10, when we're exiting properties, get to a 7.5 to 8% return. And then we can sell the deals, at the historical averages at about a 6% return. Today, buildings are actually trading as low as 4.5%. So we underwrite pretty conservatively, and we actually usually overachieve our numbers. Our first Core Plus fund was in 2007 at the peak of the market, right before the last recession. And that did about a 10.5 net investor return and about almost a 2-3 multiple. As far as other things, we have a big ESG component. We hire over 55 interns every year. Over half those will be first generation, so kids that are the first person in their family to attend college. And then we try to hire about 10% of those 55 every year, bring them into the manager group. A lot of our buildings, all of our buildings, we're doing energy conversion, so we're using low flow shower heads, changing out the toilets, doing things to cut the electrical bills, charging tenants back for the utilities, showing them what they're using and how they can control it, using different light fixtures to cut costs, and then doing things to reduce the amount of trash and waste. We also are involved in Habitat for Humanity and 1% for the planet. We have 3 really affiliated companies: FPA, which does the acquisition of the deals and the asset management, Redwood, which is our construction management company, and Trinity, which is our management company. We've owned about 600 complexes, about 125,000 units, and we have over 450 realized deals. Right now, we're about the 30th largest owned apartments in the country. These are just kind of top level things. I didn't know if you guys wanted to get into more specific questions, but I'm happy to answer any questions.
Thank you, Madam Vice Chair. Do we have any questions, comments? Absolutely. Mr. Treasurer, can we stop you?
No discount, no discount.
Well, I was looking for a discount, but what's your cap rate? I mean, there's so much cash out there.
We're typically buying deals, our average on the Core Plus has been about 5, but usually there's about a $250 to $300 rent bump. So we think we'll be at a 6.5 or so by year 5, and a 7.5 to 8 in year 10.
Get you to repeat it, I guess.
Yeah, we're borrowing money for about 3.25 today for 10 years interest only. So there's a positive spread. We're hoping to get about 60% return from cash flow. So typically we start about a year in on the cash flow, because first year we're using renovating, and that creates some vacancy. And then we're starting typically at 4 to 5% cash on cash. So we're trying to average about 5 to 6% of the first 5 years, and about 6 to 7% over the second 5 years. You'll see a little notch down in our models in years 5 and 6, because we put money back into the common areas. We're trying to use real timeless and interior units, so we're using a laminate floor, which looks like hardwood floors, and then Carrera marble laminates, things that look like Carrera marble. So we're trying to use things in the interior that don't need to be upgraded, but in the common areas, you need to do a big renovation every 5 or 6 years.
Okay. You said that you only get 1 to 2%.
Success.
Success on your offers. So are you offering a 7 or an 8%?
We're really working backwards to an IRR, so it really depends on how much upside there is. There's times we could pay a 2 cap if there's enough rent. There's other times that we have to buy something, especially our value-added fund, where the returns are higher because the fees are higher. We have to be at a 6 or 6.25 cap because there's less upside. So really, the cap rate correlates to how much upside there is in the deal, and then also deferred maintenance. So a lot of times the sellers say, hey, it's a 6 cap. We're like, yeah, it's a 6 cap, but there's so much deferred siding, windows, plumbing problems that you're a 4.5 cap, because we're not going to get rent bumps for that. So that's already with a lot of sellers. But we're really working backwards to an IRR. And then we're trying to get a 10 IRR, which equates to a 2.2 multiple on a 10-year hold.
Well, I admire your tenacity to stick with it.
It's really unusual to see a manager who worked that hard for their acquisition.
I started with my first fourplex in the early 80s.
Okay.
I was cookie cutting it every 45 days.
Wow.
And Ronald Reagan changed the tax law.
1986 tax
I
reform.
said,
That's
what
what I
I own
started.
now is all I ever want. And I just sold my last one just 2 years ago, 30 years ago. So, bless you for that. I was getting the calls, the dogs barking.
Well, that's how I started.
So, it's nice to hear somebody that's done this for so long.
Thank you very much.
Absolutely, Mr. Treasurer. Yes, Senator Ross.
Madam Chair, does Trinity Property Consultants manage property for anybody other than the EPA?
Okay, no, sir.
Okay. So
It's not a high margin business, so we really want our people focused on our buildings.
And what about Redwood Construction?
No, that's not work.
They're only doing FPA properties, right? Okay. How come the advisory committee can only review the fee structure within 30 days of the annual meeting? Why was that restricted? It would seem that the advisory committee ought to be able to have access to that information.
In 30 days, that's just how that was negotiated by the LPs, what they wanted. So they look at it once a year.
It just seems to me that it shouldn't be restricted to that period.
Well, I think we're instead of having it open all the time, to do it once a year. So they do it.
So I guess what concerns me is the ability to, I mean, it's nice to have a vertical integration, but we also have to be concerned that there's not a lot of shifting of revenue to those other partners. I mean, to manage, to the property manager, the construction, and then before the LPs get the short end of that deal. And now we have Greg Fowler. Is it Fowler?
Yeah.
Who's got that family partnership too, that he's, or the family, you know, that to some extent, some properties can get shifted into there and.
Yeah, that's not how it works, the property, everything that has to go on the fund, that's specific in documents.
Yeah, and the property management fees and construction management fees are all audited as per the audit each year as well.
They just seem a little on the high range as well. You know, particularly on the construction end.
Not really, I mean, we're not making money really at it, it pays, we overrun pays 50 people. So we're the general, we act as a general, so most people, there's a general contractor, and then the group calls charged a second fee. We're a licensed general contractor, so we take all that deal, cost of deals, we don't close. We provide the insurance, and we act as the general contractor. We don't have any subs, or we don't make any costs on it, so any discount we get is all passed through to the tenant. So it's actually one fee, most are paying a general, the same fee we're charging, plus they're charging a second oversight fee, it's actually less of a fee.
But I don't imagine that you're a licensed contractor in all
We are
the
licensed
states, in all the
contractor in
states,
every
no, in
state.
all the states that you're doing business in,
Yes,
which is,
about 27, 28 states.
and you're actually licensed in all those states.
We're actually licensed in all the states.
You're not just buying someone to do the business for. For instance, like when Walmart or some of those other, that might be a bad example, but some of these national companies come into New Mexico, they just hire a local guy
No,
and use his license.
no, we have over 70 people in our construction management. We're a licensed general contractor. We did over $110 million of renovation last year.
Okay, thank you.
You're welcome. Senator Rosslin, any other questions or comments? All right, seeing none, yes.
Based on the recommendations of the Council Investment Committee, Real Estate Advisor, the Townsend Group, SIC staff, and general fiduciary oversight of RDK, I move that the State Investment Council approve a commitment of up to $100 million to FPA Core Plus Fund 5, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate activities.
All right, we have a second by Member Lavender. Do we have any discussion about the motion? Seeing none, all those in favor say aye. Aye. Any opposed?
Aye.
All right, we have an aye. Okay, any opposed? I've got one, Senator Rosslin. Any other opposition? I think I got everyone. And no one abstaining. All right, the motion carries. Thank you very much.
Thank you very much.
All right, we are now on item 4D, New Mexico Private Equity Bayer Ventures III. We'll miss that out. On the agenda. This is from All right, thank you very much. Proceed.
Thank you. We're here to talk about Thayer Ventures 3. Thayer Ventures is a early stage venture capital investment strategy proposed for the New Mexico program. They target investments in travel and transportation technology companies, including hospitality, food service, and aerospace. And what they're looking for are companies that create disruptions within the travel and transportation markets. For the remaining investments in Fund 3, the initial check size will usually be between 3 and 7 million, with additional funds reserved for each company. Fundraising for Fund 3 began in 2017, and then it was paused in 2018 as one of the partners took a leave of absence to finish a term as mayor of San Francisco. And that's why I referenced remaining investments. The Fund 3 has actually already completed 13 investments. This is a little bit unusual for us. We're used to investing in blind pools. And that means that 50% of the target capital is already invested or reserved. The total target is 20 companies. This strategy primarily targets North America companies, but with a secondary focus on Europe. So as an example, the 13 companies that have been invested in, 11 of them are in North America, and 2 of them are in Europe. The firm has been investing since 2009, and the track record is mainly unrealized. There was more of a seed stage focus early on, and then they realized that a more mature entry point, talking Series A and Series B, would be a better fit for the team, its industry experience and connections. The firm utilizes an industry advisory board. It's 30 members, including member executives across the travel, transportation, hospitality, and food service industries. The IAB provides assistance with deal flow, due diligence, and portfolio company support. Thayer has a current investment in New Mexico, that's Robotic Skies, that is in Fund 3, which we're talking about right now, and staff and consultants discuss the near-term pipeline in New Mexico, and it includes 3 New Mexico companies right now for Thayer. Of particular interest is New Mexico's aerospace industry, including companies associated with Spaceport America. There's also 3 current portfolio companies that are in discussions to add offices in New Mexico. Fund 3 has a target of 100 million. Fund 2 was 23 million. And staff and consultants are recommending a commitment of up to 7.5 million in Thayer Ventures 3 for the New Mexico program. I did neglect to introduce our guests, Mark Farrell, Chris Hunter, and Jeff Jackson from Thayer, and of course Richard Pugmire from Mercer. And with that, I will turn it over to Richard for any additional comments.
Yeah, one thing about process, we first met Thayer about a year ago. They've been in the industry for about 10. I actually met them about 10 years ago, the first time they were there. What's been great about that time, we've been able to watch their activity in New Mexico and how active they've become in creating connections in New Mexico. And one of the things we've talked about with the council is not only bringing more investment capital, but also bringing in expertise to help the New Mexico companies. And I think with Thayer, what you can see is their focus on the travel and transportation industry. They have this strong network where they can really help companies make connections to those people in the industry that can help them be more successful. Also, when we did the structure study in November, one of the messages we received from the council was, focus on outside of Albuquerque and Santa Fe. Don't forget the other parts of New Mexico. And that's one thing that we've seen Thayer do as well, is focusing on southern New Mexico for potential investments. And so it does provide more diversity to the New Mexico program as well. One One question we often get from the council too is around the sizing of the commitment with $7.5 million. We really balance the $7.5 million with the potential they have to invest in New Mexico. We want to be able to get a good hit rate with that. And then also it's a balance between the merits and risks of the opportunity, which you have our investment memo. And then also this one is unique, as David mentioned, because they have made 13 of 20 investments. So we're expecting they're going to be back in the market fundraising sooner for their next fund than a normal fund would when we present it to you. And so we want to be supportive of good managers that are doing what we ask of them over multiple fund cycles. So we want to make sure that we don't become over allocated, so we also sized it appropriately for that. With that, I'll turn it over to Claire.
Thanks, Richard. Thanks, David. Governor, council members, pleasure to be with you. I think still this morning here in the building. My name is Mark Farrell. I'm one of the co-founders of Thayer Ventures and a partner, joined by my two other partners, Chris Hunter, who's my co-founder as well, and Jeff Jackson, who's been with us since 2010. Happy to be here. As was mentioned, we are an early stage venture fund focused on the broader travel and transportation market. We are raising Fund 3. We're at the tail end of that. We have closed on $7 million already and having our last closing in the upcoming weeks here. What I thought we'd do though today is really focus on New Mexico and our activity here to let you know how active we've been and really the partnership that we view today potentially beginning up. So first of all, to let you know, we've been looking at deals in New Mexico for over 5 years. This is really, the intensity of which has really increased over the last 2 years, I would say in particular. Last year, we made 8 individual trips down in New Mexico to various parts of the state. As was mentioned, for sure, our existing portfolio company is in Albuquerque, but we've spent a great amount of time down south in Spaceport. We have a lot of people coming out of Los Alamos as well, and we understand part of the mandate of the council, and so we very much view that as an opportunity for us to invest not only in these main corridors, but also outside of the main corridors in Mexico. Chris is actually coming back next week to be a panel on an innovation showcase down in Albuquerque. We're going to be judging all day long on different startups here in New Mexico. So we have been very active and we intend to continue that pace very much so going forward with Thayer Ventures 3 and beyond. I think it was mentioned as well, we've spent a lot of time and emphasis developing, as we start to be on the ground here over the last X number of years, a lot of relationships with different institutions. For instance, the New Mexico State Chamber of Commerce, I know based down in Albuquerque, very close to them. We work with Secretary Keys out of your office. She's been amazing about talking to our existing portfolio companies about all the incentives to come down to the state of New Mexico. Very much view that partnership and bringing existing companies in our portfolio down here as part of our mandate, as part of this investment. So we continue to develop those relationships, as well as these other incubators, the University of New Mexico Tech Incubator Lab, Air Force Research Labs, and then down to Spaceport, from Spaceport USA itself to Virgin Galactic. We have those relationships. We're talking about deal flow. And for us, it's just the beginning of what we think is long-term deal flow and opportunities for us to invest here in the state of New Mexico. We do have a current investment in this fund that the investment is contemplated in New Mexico. It's in a company called Robotic Skies. We co-led the round last year with Boeing, with a number of existing investors. We're a very active investor. I sit almost essentially the board of directors, so we're here very often with that company and very active with them growing throughout the United States and beyond, and plan to continue to do so. We also have a strong pipeline of additional deals here in New Mexico. We see the future of our activity here in the state, certainly in our core hospitality areas, but also around aerospace. Chris and I went down to Spaceport last year, spent the full day down there. We have a trip planned late Q1, early Q2. We're still figuring out dates to be back down there. The impact down of Spaceport in the aerospace industry and what's emerging down there is just the beginning. But we really view that as long-term growth and opportunities for us to invest in that we're incredibly excited about. We also think it's going to be a big driver here in New Mexico. And it was highlighted, and I want to mention it again, we really view that feature outside of the Albuquerque-Santa Fe corridor. To note, we are a San Francisco-based venture fund, but 9% of our deals are outside of the Bay Area. So we are very familiar with investing outside of the Bay Area, not just core urban markets. We believe that's where we find the best deal flow. It wasn't touched on earlier, but part of our thesis as an industry-focused fund, we believe we have a strong team, we have a strong track record around it, but it's also our existing limited partners in our funds. So already existing partners and investors in Fund 3 include the world's largest sovereign wealth fund, but also Marriott, Hyatt, Host Hotels, Travel and Transport, Enterprise Holdings, which includes Enterprise Rental Car and all their companies, off their balance sheets. We have a ton of strategic partners in our industries that we invest in that are LPs in our funds that we also bring to bear to our portfolio companies, but also to other companies that we look at and don't actually end up investing in as well. So at the end of the day, we view ourselves as an industry-focused fund that has a lot of presence on the ground right here in New Mexico, and we are super excited about continuing that. We've been talking with your state investment council, with Mercer for some time now, and we believe the opportunities will continue to present themselves here in New Mexico. So we're excited to be here. We're happy to answer any questions you might have, but very much look forward to hopefully a long-term partnership.
Thank you very much for your presentation. Do we have questions? Yes,
Chair.
Messina.
Thank you. You invest in technology in these areas. Would you explain to me or give me some examples of what that would be? Because I have no clue as to that. Please.
What do you want to talk about, Robotic Sky?
Sure, well, for example, yeah, sure, Robotic Skies. So Robotic Skies is actually a drone company, a company in the drone space, and that's our one existing New Mexico investment out of Fund 3. So I think it demonstrates the breadth of the global travel and transportation market is so broad. So it includes, for instance, the drone market. So Robotic Skies is a company that is rolling up the maintenance, repair, and overhaul operations for a commercial drone market that is emerging here in the United States and globally as well. So it's founded by some New Mexico entrepreneurs that have been around the aerospace industry for quite some time. So we're incredibly involved with that. We have technology companies that are in hospitality, so in hotels, companies that design central reservation systems for hotels. We have companies in the airline industry, companies that are doing all the back office for interline travel for different airlines in particular. So we have a very broad mandate within travel and transportation. For sure, we are technology investors. So we look for technology opportunities within them. That is core to our venture portfolio and drive venture returns. But it is a broad mandate where, I think what's excites us in particular about being here is that we've been looking at deals in New Mexico, again, for a number of years. We have one investment, but we have a strong pipeline, and these institutions and where a lot of this economy, especially around spaceport, is going here globally, we believe there are going to be opportunities for years to come here in New Mexico, and we're excited to be part of it.
And I, if I could, I'd add to that today especially, technology is a part of every company, right? And so in a lot of ways, what we really do is we invest in tech-enabled services, tech-enabled companies. And so, in this sort of new wave, this sort of third wave of development of businesses, we like to find entrepreneurs who are working in particular industries and solving problems. The fact that they're using technology to enable those creative solutions is kind of table stakes, really. But it's about, the solutions themselves. And then very specifically, when we engage with them, we not only help to try to shape the way their businesses are structured, but we help them develop the strategies that take them on a national scale and then ultimately global scale, which is, what I think a sort of rise of the rest like fund needs to do, right? Is we're investing in markets outside of Central. We work very hard to make those connections and live those opportunities.
Absolutely, Madam Chair.
You think you mentioned 3 additional New Mexico-based companies you're looking at. Can you tell me the status of your due diligence on that, where what kind of?
Sure, absolutely. So they're in various levels of due diligence. We've met with each one of them a number of times. We're meeting one of them this afternoon after this meeting. Again, Chris will be back down next week to meet with a few other ones. So those are in various levels of diligence. We have an existing portfolio company where we've invested and we've reserved additional capital to continue to invest in that company. So the proposed $7.5 million investment, we feel very comfortable that we'll be able to put that back into the ground in New Mexico. But in addition to leverage all of our relationships to bring additional capital to bear for not only, again, our portfolio companies, but I think it's important that also companies that we look at that might not be an investment fit for us. And we like to bring our LPs and our existing network to bear wherever we are. And so we view that as a big part of just growing our own ecosystem here in New Mexico, a long-term deal flow and investing in the state.
Thank you. Any other questions or comments? Yes, Mr. Treasurer?
Thank you, Governor. I guess this is more, Richard's already, he already knows that I, but under the strategic fit and the Mexico activity you have in your material amount of time that you spend in the state, and you just mentioned you spent a day down south at the spaceport, but how do you define material amount of time?
Again,
I mean, I obviously, I try not to leave it, so, you know, but you're from San Francisco.
well, I will tell you, I have my wife and my children committed to our next family vacation is actually down here. So
Hey.
I'm excited about that. As I mentioned, what's that?
I said, good.
Yes, absolutely.
Spend a month.
I'd love to. You know, again, last year alone, we made 8 trips down here. They vary in length from 1 day to 3 days. I think it will certainly be dictated by our existing company here, the opportunities we see, but it's also, over the past few years, we've spent time down here on purpose just to build relationships with different institutions that we believe will foster long-term deal flow here. And that's important for us. And so we're going to continue to do that. This for us is a commitment that we're voluntarily coming to because we're down here already. And we view this as a long-term partnership. And so we'll continue to do that. You know, to the extent that we can weave in personally, longer trips with family as well, we definitely want to do that. But I think those trips, 1 to 3 days long, if not longer, again, will depend. But we view those as, again, a core part of what we've been doing and what we will continue to do.
I noticed it's a small amount of money that you're asking for. Management fees are at 2.5%, but at 20% carried interest, but there's no hurdle.
Yeah.
So,
Yeah, we've been spoiled the last couple of venture capital funds we've brought you where there's actually has been a hurdle. I'd say it's more common for a venture capital fund not to have a hurdle because there's uncertainty about the holding period and how long they're going to need to take to come to a realization event. You know, typically on an early stage basis, 5 to 9 years is kind of the range that most people give. So yeah, this fund doesn't have a hurdle rate, and then on the management fee side, it is at the higher end. But when you look at the previous funds, they don't have a large amount of capital from previous funds that they're collecting fees from, and they have an experienced team that they're actually growing as well as part of this fundraise, and so we feel the fee is appropriate for this time. They were raising a much larger fund, and they had 3 or 4 previous funds that they were collecting fees from. That would be too high.
what really caught my attention, and that's in your presentation, Richard, is pages 384 and 385, which is their Fund 3 investments.
Yeah.
And I noticed that all of that, the 13 investments, only one of them went into Mexico, which is But when you break down each one of them, I think I've got 2 that I wrote down okay, and 1, 2, 3, 4, 5, 6 are behind. One is 0 value, and New Mexico, you still have down there make it time. So the success rate doesn't look here based on education. And even though it's only $7.5 million, it's not my money. It's somebody else's, so to speak. So can you kind of go into that a little bit more?
Yeah.
Maybe make this sound a little bit
so
less negative than the way I read it, I guess.
There's a balance here. This is a little bit unique in that it's not a complete blind pool. And then we have some visibility into 13 investments that are going to be in the fund. And so your commitment is actually going in at cost. So it's not at a market value of what the existing investments are. So on day one, because in aggregate, the portfolio is actually marked above cost, you're going to have a gain on day one. The other aspect of that is usually when a fund is called capital prior to you going in, there is what was called a makeup fee, where because other limited partners have basically been financing your capital call, you have to pay some interest fee, usually around 5%, but it could be up to 8%. And that's being waived in this case, so that's positive as well. But I want to say that that's not the driver of doing
this commitment is the fact that the valuations are actually above cost. It's more around Thayer's expertise and what they can bring to New Mexico. When you look at the individual portfolio companies, there's always, especially on the early stage companies, there's always times where they might be behind plan, or they might actually have to shift strategy completely, because what the original thesis was may not actually fit what the performance is gonna be on the company. And so they have to actually shift. And there's one company that, potentially looks like a write down to zero, but in aggregate, it looks like right now where the portfolio stands, it's above cost. And a high loss ratio is expected in these type of strategies. I mean, it's usually a risk that we point out with the volatility. It's not uncommon to see, 50% loss ratio on this. And what you hope is that, in the other 50%, that they're getting outsized returns to more than offset that loss. And that's what we're really putting our faith in Thayer with their expertise, the industry connections they have, that they can be able to drive to success these companies that they fund.
And as Chris and I put in the structure study, venture capital is a kind of different animal. It's a very difficult animal. As a result, a lot of the performance tends to be uneven compared to a lot of the other investments that you'll hear come here. If it's apartments and you're refurbishing and redesigning it, and then soon it should be generating cash flow. Even some of the real asset infrastructure investments, they're a little more straightforward. In our space, some of the buyouts, some of the growth tend to be a little more straightforward. Venture capital, you're going to find an uneven path a lot of the times. You're going to find some variation, different paths to the eventual product that you will end up with. But what you're hoping for, they're at a little bit of a disadvantage here because most of the time you don't have companies, you have blind pools where you have you don't have updates on them. They're at a little bit of a disadvantage because of that, but we think that this is a strong enough team. That's what we like about there. The backgrounds that these three gentlemen, the partners, bring to the table, their connections in the travel and transport industry, and the fact that they have made strong investments in the past, and we're expecting that to happen also.
Thank you, Gary.
Thank you. Any other comments, questions?
Yes, and I know we're running late, but I want to sort of give the other view of the treasurer's perspective. Because I actually, after years of beating this drum of we have all these opportunities of technology, development at our national labs and our history with aerospace, we need the capital. It seems like it's sort of slowly trickling in. And so I actually really appreciate this investment being brought to us by staff and our consultants, because this, you hit on it yourself. This is sort of the unique composition of New Mexico and what New Mexico has to offer. And we would love to get a little bit of infusion of capital into that. So I'm very excited about this investment. So as you all know, the land office sometimes will be involved in some of the companies that the investment firms are making investments in. And so I've sort of struggled about whether to recuse myself from votes or just announce that. And so I think after some legal advice, what I've decided to do is just disclose to everyone in public that we're looking at possibly working on the hyperlink project at Spaceport with State Trust. That's what I'll say. So with that.
Great. Thank you, Madam Vice Chair. Anything else? All right, seeing none, I think we're ready for someone to make a motion. I wonder who that someone might be. Thank you, Member Riggs.
Based on the recommendations of the Council Investment Committee, New Mexico Private Equity Advisor Mercer, SIC staff and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $7.5 million to Thayer Ventures 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Right, we have a second by Member Lavender. Do we have any other discussion related to the motion? Seeing none, all those in favor say aye. Aye. Any opposed? Anyone abstaining? Hearing none, the motion carries. Thank you very much. Thank you for your presentation. Yeah. 4E, risk system.
Well, thanks, Governor, and how Smith's also coming to the table to present. Let me start this one out with maybe a little bit of inside humor to the investment committee. At long last, we're bringing a risk system. I've been the stopping point for that over the years. With the investment committee, we've had plenty of back and forth discussions on these risk systems. Because our portfolio has so much private investment allocation in it, these quantitative risk systems have a hard time capturing the true nature of those investments. And therefore, when you try to put those in alongside the public markets investments, it's sort of garbage in, garbage out. But at long last, technology's caught up and to these products.
Harold?
And finally.
Can you suspend? You can't hear.
I'm sorry, I'm all sorry.
I believe me, we know who started.
My fault.
We'd rather have members who are fully engaged than not, but you're hard to hear over, even when you're whispering.
I know, my children have said that for years and years and years, Dad, you can't, so I talk to them.
That's all right, thank you.
So, to the joy of the investment committee, that was the impression I got. We finally have a risk system here that we think the technology is caught up to adequately model our private investments, to be able to put them on the same footing as our public investments, and actually give us good numbers in and good numbers out. So Miles here, he did most of the work on this, did a fantastic job in 4 months, Miles? 5 months, and he quarterbacked this thing the whole way. He's got a great background in risk and risk systems, so he's got good technical expertise on it. So I think all the stars aligned, and here we sit before you with the risk system.
Thank you. Proceed.
Thank you. So State Investment Office would like to recommend a subscription to BlackRock's Aladdin with the asset class risk system. At this juncture of time, investment office is using two completely unrelated analytical systems. These are the Burgess for private assets, private equity and real estate, and we are also using the EPRON for, we are using FactSet, yes, for the publicly traded equity portfolios. Subscription to BlackRock Aladdin will allow us to generate a really high quality risk data. It will allow us also to have a really holistic, high level view of risks in our portfolio, as well as individual managers, asset classes, and as I have said, the total portfolio level as well. So to touch base on the process a little bit, we have looked over the last 4 months at 5 leading risk management system providers. We invited 3 of them to come in and do the presentations and demonstrate their modeling capabilities. As Vince have mentioned, everybody is using the same quantitative models, everybody is using the same proxies, everybody is using the same modeling to get the numbers. But here we have to look at some competitive advantages. And BlackRock has actually 2 of those. So number one, private equity asset class modeling. It's a little bit harder to model private asset classes risks than it is public asset classes. And here, what BlackRock Aladdin has a competitive advantage in can be attributed to the fact that in May last year, they have acquired eFront, which is the leading, actually global end-to-end investment management for alternative asset classes. So BlackRock has acquired them in May last year. They are halfway into integrating that system into the BlackRock Aladdin risk system, and by calendar year 2020, it's expected that the integration process will be complete. And number 2, Vince has mentioned that already, in risk management, there is a saying trash in, trash out. So it's all about the data. And BlackRock invests on average $250 to $300 million a year to improve their data management and technical capabilities. They also will assign the managed services team for our account to help us with data cleansing. And this team will also make sure that all the data, all the inputs are correct. That will help to ensure that all the outputs and all the data and the numbers that we get actually make sense. So having said that, BlackRock had a really huge competitive advantage over the other risk management providers. And now, last but not least, speaking about the numbers that the council committees really like to talk about, money. The cost of the system came up to be $694,000 a year for up to 10 users, which is pretty much everyone on the investment side of things. That cost will be partially offset by the cancellation of the above mentioned system, so $188,000 saving from the cancellation of purchase, as well as about $165,000 from the cancellation of fact set. So that will bring down the cost on the net basis to about $346,000 annually. And to put that number into perspective, in 2013, BlackRock Aladdin was offering this service for $1.1 million a year. And 4 years ago, it was in the region of $750,000 a year. And mine, this is on the BlackRock Aladdin. We are getting for $694,000 risk system from the Aladdin, as well as the E-Front that will model and cover private asset classes. So I think that's it, my part. Open to any questions that you might have.
Madam Chair, this is one of those, I cut him off at the investment committee. My feeling is if Vince and his people need this, we manage $28 billion. If this will make it better, I strongly urge we approve this without any issues.
Thank you very much for that strong endorsement. Any other, yes, Mr. Treasurer.
With 10 users, are you trying to move management into the office?
No, I would say so.
And why 10 users?
That's just the standard, Mr. Treasurer, that's just the standard package. I mean, that can be negotiated, you know, if we get more staff members on. This would just give everybody access to the system to generate any reports that they'd like to see for their portion or how their portion of the portfolio fits into the broad.
How long before this would go live?
Well, it's a great question. So it was estimated that it will take about 3 to 4 months to have the complete integration. But we should really take it with a grain of salt, and I would say that 5 to 6 months would be a fair estimate. So if we start the process, let's say in March, we expect in September or October as the date when the system is going to be fully implemented.
Vince, how important a role would the conclusions from this risk management make on our 3-year asset allocation plan or on the liquidation?
Little impact on either of those. I think the output that you'll see, the output that the investment team will be able to use and that the council will be able to see summary reports of or any reports, obviously, really will provide some backup and support and some confidence in the performance numbers you see and how our asset allocation is actually diversifying us, where we might have some investments or some bets relative to the benchmarks that you set. It'll provide you some more comfort and security on those issues. Is primarily from your perspective, that would be the output for this system.
So you can look at risk from 2 different angles. One angle is the historical, so you can look at, let's say, for the last year, the return was X. The risk associated with this return was this. So the risk-adjusted real return that we have achieved was 5%. Or you can look at risk as a really forward-looking thing. You can do stress tests, you can do scenario analysis, you can look at asset allocation under different angles. And then it will kind of give you a much broader perspective and much better understanding of how you invest your money and what do you actually get as a return, rather than only looking at the historical side of things.
We have been anxious for such a thing, but we didn't think such an animal existed, so.
It didn't until now. We think this generational jump that BlackRock's made is generational. This is the first one that funds like us that have significant investments in private investments. At least from my perspective, this is the first generation that we can have enough confidence in it's worth the price.
Okay, any other comments, questions, concerns? All right, hearing none, yes, please.
Based on the recommendations of the Council Investment Committee, SIC staff, and General Fiduciary Homicide Body K, I move that the State Investment Council approve a subscription to BlackRock Aladdin multi-asset class risk system as discussed, reviewed, and memorialized by the Council Committee.
Second.
Terrific.
I beat him.
You did. I would say it's very impressive. All right, are there any other questions, comments, concerns on the motion? Hearing none, all those in favor, say aye. Aye. Any opposed?
Aye.
Aye, delayed affirmative, any abstaining, seeing none, the motion carries. Thank you very much. And we are now on item 5. So we have the CFO report. Brett.
No more than 5 minutes. I'm on page 461. This is the summary for our budget. As you can see in the far right-hand column, we're projecting savings to the end of the fiscal year. I would point out it's showing over $12 million at this point in time. We're only through the end of January, and as Raquel just presented, the Aladdin purchase will impact these numbers a little bit, very much at all. And then next, I wanted to go to page 469, because there were some questions on this last time. This is the severance tax permanent fund page of the investment holdings report, the entire investment holdings report. I wanted to just point out to everybody, if you scroll down, you can see Small Business Investment Corp toward the bottom half of the page, $96 million. That new amount does reflect the additional 1% contribution that we made to the SBIC. And I also wanted to point out, because there was a question last time about them coming and visiting the council. We did reach out, I think Charlie did, and talk to Russ Cummins. He suggested maybe toward the latter part of the year, which will give them enough time to get through their annual audit, their annual reporting process, as well as a little bit more time to deploy some of the money that they've received. So I just want everybody to know that we do have them on the calendar, hopefully in the future, to come in and actually speak to them. And then on page 502, this is the notes to the investment holdings report. I tried to point out the items that are noteworthy here, but I did want to point out again, and especially for the land commissioner, on the first bullet there, the monthly contribution from the state land office in January was $101 million, which is an increase of $6 million from December. And then the comparable number last year in 2019 was $69 million. So,
And is that the first time the contribution
And a vice chair, please proceed.
is that the first time the contribution has gone over $100 million?
yes, it is. It is. So keep that up, if you would. We want those amounts coming in. And then I always point this out because invariably someone will ask about it on page 503. I do provide this just because if there's any schedule we get a lot of questions on, especially during the session, is the land grant permanent fund. This is the land grant permanent fund as apportioned by beneficiaries. So if you look in the far right-hand column,
Common schools is the biggest number there. It comprises about 85% of that total, and you can pick any of the beneficiaries that gets a distribution during the course of the month and fund them actually on the schedule. And then lastly, I did want to point out that we will be working diligently in the accounting area to get the Early Childhood Trust Fund account set up with Share. So come the new fiscal year, we're ready to roll on that.
Perfect.
So that's all I have, Governor. Thank you.
Any questions, comments about the finance report? All right, thank you very much. Appreciate that. We are now on closing matters. Does anybody have any old or new business to report? I just want to thank everyone for their incredible work during the session. Plenty of additional opportunities for setting up new funds, as we've heard several times today, the Early Childhood Education Fund, and looking at additional ways to, with New Mexico investments to grow the economy, and good work by all of our statewide offices to that end. And so we're really actually very delighted at the end result of the session. And we hit the secretary, got the legislature to get to 25% reserves, which we believe is the highest ever. And we are working diligently to continue along that path. And while there will be some disagreement, even I think among individuals, not as they participate on the council, but how they feel about what the overall budget and spending patterns are. It's $250 million lower than projected revenues, and we want to continue to be aggressive in growing the economy, taking care of our greatest assets, which are families and children, but making sure that we don't do that in a way that would be irresponsible and wouldn't meet any of the prudent tests that are required for the work of this council. So thank you for letting me express that sentiment. And we're getting the signing period. So I think I can stay until the closing of the meeting, but we'll see. Yes, Senator Lawson.
I move that we adjourn as discussed, reviewed, and memorialized by the council today.
Fair enough, except that we need to do public comment. And I want to make sure that 6 feet, but that was a very good effort. I applaud that. The next meeting is on March 24th at 9 a.m. Here in the Cabinet Room. And we are now at item 7 on the agenda, public comment. Mr. Knoll, and would you introduce yourself too?
Kevin has proven to bring us way ahead of what we've been many years in the past in helping New Mexico businesses. Big accomplishment friend of mine. I lost a bit in my total that bill would not pass 136 and I get the committees and your leadership and through a certain enthusiasm in the legislature about the things that we see down the line as far as the participation of this body and the cooperation of the leadership to make New Mexico a better place. Just kind of that presentation by favor. My only things of warning, we're not talking billions, we're talking millions. There's a risk. Sometimes, I work in opportunity zones. I talk to hedge funds, they say, oh, I can't, we can't invest in this, but it's looking for $100 million profit. And we're in the time. But congratulations to you on that great session. And thank you.
Thank you. I appreciate that. And thanks to everyone around the table for their great work. Yes, ma'am.
Well, my name is Karen Munson. I'm here from the House. And I'm wondering if, obviously, a lot of the issues that come forward to this commission council happens outside of the room. Decisions made because it seems like the votes are kind of in when it comes to the table, or maybe it's just all red. But I was wondering if there's strategic planning going on that this permanent fund is involved in with moving into green energy, the new energy transition. And where those things and discussions are taking place. Is it here in this room when people are pitching their there are things to invest in, or does it happen outside of this room? The discussions about what percentage of the permanent fund needs to go to, or new energy transition that needs to happen.
I'll let anybody take that on. It's a combination of things, so it's not that decisions are made. The decisions that are required to be made public are in fact done so in the way that we need to. So we're providing transparency, but the day-to-day management about what we can responsibly and should responsibly be doing with the permanent fund and all of the funds happens every day. And then we've got subcommittees that are also open to the public that we have concrete discussions. So that by the time we get here, instead of a 12-hour meeting, it's a 3-hour, sometimes 4-hour meeting. In terms of the strategic planning, yes, last year we talked about looking at how we might increase both our participation, and we've seen legislation get over the finish line that does that in New Mexico businesses to make sure that we're thinking about, there was a conversation about that today, about renewable energy. It may not be specific to the ETA, but clearly specific to investment strategies, bringing in businesses that will do that, and thinking about where our investments go. It's not all philosophical, but it is I think, healthy, strong commitment to both, where we get the right rate of returns, that we can meet our commitments to the public, education, and be effective fiduciaries, but also philosophically think about where the country and the world ought to be heading, and how that provides not only a good rate of return, but meets certainly, which I can do, I think, this administration's clear effort to participate in the Climate Alliance, the Paris Climate Accord, and making sure that we're doing as much as we can in that and related to climate change and investment opportunities, and where those mirror each other. Anybody else want to take that on?
Yeah, and Karen, you missed the beginning of the meeting. We actually talked about a memorial that had passed out of this last legislative session for the strategic plan. So we are.
Where does that happen?
We're going to embark on that. That's tasked to this agency as well as a couple of other state agencies. So those folks.
This agency being the State Investment Council?
Right, is part of a collaborative team.
And that collaborative team is?
You can read the memorial. It's the Economic Development Department, it's the State Land Office, it's the Energy and Minerals and Natural Resources Department, and then we talked about other partners that we could potentially bring in, but those are the partners called for in the memorial.
One of the wonderful things about this state is that we have the resources of sun and wind, as you know, and oil. And we've put for many, many years, I mean, we could be really farther ahead in this process like other states are. So I'm just wondering where this body is in relationship to this whole issue. And like how to find out about that, and like where to go to see where the planning and how these investments come and how they get decided on.
So 3 more quick things. One, we'll make sure that the council provides you with all of their information. But I think what you're probably looking for is more directly related to what's going on in the cabinet. So economic development, MNERD, and the environment department. So New Mexico actually is not behind. We're in incredible leadership positions with some of the highest renewable portfolio standards. And right now, if not the second or the first highest wind energy investments and storage investments. We are also on track, and I'd love to say that we're ahead, but not quite, on the transmission lines, without which we cannot store, export, and move any of that energy, which limits the investment strategies and the opportunities for a state like this that is one of the best wind and solar states in the country.
But this permanent fund is an enormous resource for the state, and that money goes outside of the state, obviously all over the world. So there's a big opportunity for that money to be here, investing in infrastructure that could have already been happening by now. So I'm just wondering if this is seen as a resource for this transition or not, the funds that are in this fund.
Yeah, it's more complicated than that. So perhaps I'm gonna ask that Director Moise spend some time with you, and then make sure that you've got access to also our climate task force, which is a variety of things, and our infrastructure. I mean, I worry about overwhelming any member of the public with too much information, but it's all public. So we want to make sure that you're armed with as much knowledge and information as possible, and then perhaps we can garner more recommendations from the public just like you, and make sure that we're on track to do as much as we can.
Thank you.
You're welcome. Thank you for being here. Any other public comments? All right, seeing none, can I have a motion to adjourn the meeting? We already have one. I'll repeat the motion earlier by Senator Rawson. We've got a second by Member Eitzen. All those in favor say aye. Aye. Any opposed? Any abstain? All right, motion carries. See you next time.